rates are something I or Elizabeth Warren never imagined. And Senator Warren, I think at 3.5% has a great point. Why aren't we celebrating this and solving inflation other ways?
Well, the problem is that on one hand, if you have people who are fully employed, they're going to keep spending. And if they keep spending, you end up with a more persistent inflation. That's the theory. On the flip side, if you start getting layoffs, that also has a cycle of its own. And once they start, they feed on each other. And this is the fear. This is sort of the tipping point. Are we ending up in a situation where either we're overly employed and can't get inflation down, or do we start a cycle of unemployment that is very hard to stop? And that, I think, is really the big fear.
The Fed's got it going from 3.5 to 4.5, then 4.6, and just kind of flattening out over a couple of years. It's all very calm and smooth.
Exactly. It's a managed statement forward.
Is it ever that calm and smooth?
No.
It doesn't work that way.
Totally. You're going to get me going here. I have my morning tang. The answer is no. You're 100% right. It's not predictable, and these are well-meaning officers. I mean, no ill will. They're managing a controlled glide path because that's public policy in a political milieu.
Well, talking about a political milieu, how do these projections really face off with a political cycle when you have the likes of Ron DeSantis already coming out and really eviscerating the Fed currently and saying that this is all politicized and that they were too late and that they're moving too fast and they're going to be the piñata no matter what. So how do these projections change to really get their will through?
I don't think they'll change based on politics. I think they're going to do their best effort, as Blarina mentioned, of lags, to try to guesstimate in always a challenging environment without politics. I just don't think they're going to sit there and go, DeSantis is behind by 20 points. Change in the minutes. Take out several and put in few.
Yeah.
Is he going to announce anytime soon?
What, Ron DeSantis?
Yeah.
Hasn't he announced already? I mean, basically, it's like de facto.
It's not official yet. Isn't this a book tour? I thought this was a book tour.
Oh, right.
It's a book tour.
Oh, whatever. Does anyone buy that?
It's
anyone?
a book tour. I'd buy it. It's a book tour.
Yeah, you're buying the book?
Yeah, I buy everything politicians say. It's a book tour.
Oh. We're just going to leave that there.
Coming up
just
next,
silence.
Tim Adams of the Institute of International Finance. That conversation from Washington, live from the nation's capital for the IMF World Bank spring meetings. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Last month, policymakers shrugged off bank failures to deliver a 0.25 percentage point rate hike. Today at 2 p.m. in Washington, we find out the thought process behind their decision when the Federal Reserve releases minutes from that meeting. The March rate hike brought their benchmark rate to a range of 4.75 to 5%. China indicated it will maintain pressure on Taiwan following its large-scale military drills. The maneuver began after Taiwan's President Tsai Ing-wen met last week with U.S. House Speaker Kevin McCarthy in California. A Chinese spokesman said, quote, "We will not leave any room for any form of Taiwan separatist activities." Senator Tim Scott of South Carolina is one step closer toward challenging Donald Trump for the Republican presidential nomination. Bloomberg's learned that Scott is launching an exploratory committee that would allow him to start raising money for a campaign. He's visiting several early voting states this week. Walmart is cutting the number of stores in Chicago in half from 8 to 4. The nation's largest retailer says it hasn't made any money in its 17 years in the city. Walmart faces tough competition in Chicago from Target, Albertsons, and Aldi. It says that crime and theft were not main drivers of the decision. Bloomberg's learned that Emerson Electric is in advanced talks to acquire National Instruments. Emerson has offered $60 a share for the maker of measurement systems. National Instruments closed Tuesday at a little more than $52 a share, giving it a market cap of $6.9 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Seeds, typically between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
We have to be vigilant because some of these pockets of vulnerabilities could spread, and then they could spread to the whole financial system. But what we are seeing right now is the risk that banks are going to look at the outlook and are going to be a little bit more prudent in extending loans going forward, and that could weigh down further on economic growth, both in the U.S. and in the rest of the world.
super gloomy stuff from Pierre-Olivier Gourinchas there, the IMF chief economist. We'll pick up on some of that gloom in just a moment. Live from Washington, equity futures going into the CPI report a little bit later this morning at 8:30 Eastern Time, shaping up as follows. Positive by a little more than 1/10% on the S&P. Yields a bit higher as well by 2 or 3 basis points this morning, Tom. 345.43 on a US 10-year.
And we'll look at 8:30 to see how that changes. I'll be looking at the 2-year. I mean, inside, you got to look inside as well, 3-month and 1-year paper. John, but to me, the 2-year is the thing to look at.
Back above 4% this morning, Tom. 4.06% or so.
Yeah, and that's a substantial move over the, in the wait and see of the last 3 or 4 days. Right now, we're going to wait and see on a banking crisis. We do this with Timothy Adams, president and chief executive officer of the very important IIF, the Institute of International Finance. This is a gathering of, I'm going to say, the large bankers, and he's going to get upset with me. I mean, that's what he's going to say. The stereotype is it's 4 bankers and you. Is it you, Moynihan, Diamond, and the rest sitting around one table? Who is the IIF?
400 institutions, 65 countries.
I nailed that. Thank you. I nailed that. This is a unique occurrence, folks, and we're going to audible here on this banking crisis and your fury over it. I'm going to go back to 1833 and a guy from Tennessee. Yeah. You grew up in the aura of Andrew Jackson, and he said our biggest fear is bank consolidation. If we went from 4,000 smaller banks, they're not part of IIF, to 3,000 smaller banks, would anything change in your Kentucky?
No, not at all. And if you look where we were in 1930, we had 30,000 banks across the United States, and now we have 4,200 FDIC insured institutions. The trajectory is pretty clear, not only in the United States, but globally. We're going towards greater consolidation. Technology, it's a scale business. And the cost of technology, whether it's for AML or for providing a customer experience on the front end, is incredibly expensive.
My concern with this, it's so important, is we had a marketing scheme in Silicon Valley wrapped around the gauze of a bank. We all had enjoyment watching this SVB blow up. The concern that we have to have is the new banking environment we have. What does IIF say other than read Jamie Dimon's annual letter?
Well, Jamie Dimon's annual letter is pretty darn good, so I'd urge everyone to read it. Look, we have consolidation. It's going to be a different system going forward. Technology has dramatically changed the way in which financial intermediation happens. And artificial intelligence, the ChatGPT revolution, is going to only accelerate that process over the coming months and years, and it's happening at a breakneck pace.
You don't think this is a banking crisis?
I don't. I think it's a market turbulence. As we have transitioned from a period of low negative real interest rates, huge fiscal support. Look at the deficits we've run, and you read our annual debt report. to a period that's more normal. But going from one transition to another, we were going to see things pop. I didn't think it was going to be Silicon Valley Bank, but I do think we'll see other stresses in the system. That's not a crisis.
What kind of stresses are you expecting to see?
Well, there's a lot of concern about commercial real estate, something we've been watching. I don't think it's a crisis, but I think it deserves our attention over the coming 24 to 36 months.
Is there something about what's happened with some of the smaller regional banks that's going to lead to issues in CRE?
Well, certainly there's a feedback loop, so that's why I think it's worth watching. And there are concerns. But if you look at credit card data, is still pretty strong. C&I is still pretty strong. Obviously, commercial's down. But the system is pretty normal. Think about it. 99% of our banks in the United States or globally over the past 4 weeks opened their doors and had normal business. This is a small slice of very unique idiosyncratic institutions.
No one enjoyed watching it and its demise. No one enjoyed the fallout of companies that are struggling to wonder where they're going to get the money to make paycheck. There also was a larger question around what does systemic mean in a new era when there are specific banks that have a dominant position in specific businesses. How has the idea of systemic been redefined?
Yeah, I think it's concentration risk. SVB was the dominant player, not only in Silicon Valley, but in the Research Triangle in North Carolina, for example, 6,000 institutions it supported. So it's concentration risk. So we need to think about other institutions that are dominant players in a particular industry or region and ask ourselves, what kind of risk does that pose if they become stressed?
How much of that equation is shifting to a geopolitical question of which banks have more dominant positions in specific countries where there are increasing tensions between, say, the U.S. and China or the U.S. and certain Middle Eastern nations?
It's a great question. As I just said, as we were coming on air, it's the geopolitical issues I still worry about. I was in Japan last week. The dominant conversation was U.S.-China relations, U.S.-Russian relations, China-Russia relations. President Macron had just visited, landing in Beijing. Those are the issues that keep me up at night.
How concerned are the executives you meet with? How much do they feel like there is a storm bearing down, as Jamie Dimon was talking about, or reflect the gloom that you hear from the IMF projections?
Coming into the last few weeks, we've really tried to look through the cycle and be prepared for 2024, which is do we have the technology, do we have the talent for recovery and growth? But it's the geopolitical concerns, the fragmentation, which the IMF talked about in their annual report, the issue of U.S.-China relations, which seems to get worse by the day. Those are the things they're most worried about.
Is there anything that your partners, financial institutions, are actually doing that would suggest there's anything to worry about with regards to China? Don't they all just want to be there?
Well, China's been an allure for 150 years.
Has that changed?
But I think there is questions about de-risking, as we are seeing with respect to all supply chains, not just the financial sector, but the real economy as well. I think we have to worry about what are the risks of operating in a variety of different markets. And if you look at many of our firms were in Russia for decades, that became untenable, right? So we have to look at other geographies that could become under stress.
Is there any evidence whatsoever that financial institutions are ever proactive about any of this? I mean, we've been talking about Russia for years and years and years and years and years. It is not a surprise to anyone. I don't know why we talked about the last 18 months as if it's surprising. It's not surprising. It's not a shock. It's a failure of leadership in Europe to see this one coming. Chancellor Merkel was warned about this repeatedly, didn't change the energy relationship in any way, shape or form. And financial institutions have been caught with their pants down in Russia. It's hardly a shock to anyone that this has happened. So why were they still there? And is there any reason to believe they're going to be proactive about issues like China? I'm not convinced. Are you?
Well, I am convinced that we are sensitive to the risks of U.S.-China tensions. It is the product of every conversation we have at our board meetings. Now the question is, what do you do about it? And that's the same question the real economy is having. Lots of real economy CEOs are saying we should de-risk. Are they moving out? Not clear that that's happening.
When is the risk of stranded assets going to supersede the risk of losing out in profits?
In terms of China? Well, I'm not sure we're going to have stranded assets. We talk about stranded assets a lot with respect to climate change, but the timeline of that is very different from the way in which we do capital planning.
Tim, this was an education, a clinic. It always is. Tim Adams there at the Institute of International Finance. Tom, some difficult topics we've got to talk about for the next several years, I'm sure.
Well, that's the geopolitical tensions. As Mr. Adams mentions, the fragmentation seems to be the buzzword from Kristalina Georgieva. I'm worried about the fragmentation in America. And to me, the arch question here, moving from 30,000 banks to 4,200 banks, is where does that lead to? I'd go north of the border. What's wrong with the Canadian model? I mean, I'm not the Swiss model of 3 banks to 2 banks, now to 1 bank.
I thought you were moving to Canada.
I don't think anyone wants the Swiss model, just to be clear.
Yeah, I mean, even the Swiss don't want
they
the
don't want
Swiss
the
model.
Swiss model, but I would suggest the hysteria of 1833 is no different than the hysteria of 2023 on all these banks, and do we really need them to find supervision and efficiency?
There is this big quest to preserve the regional banking model
Huge.
in the United States. I don't think that's going away anytime soon, Lisa.
A lot of people, and I really go back to Wendy Schiller at Brown University, when she said, in some ways, people's local bank tied them to their communities, and that this actually connected them politically and it connected them in a larger sense. Has that gone away, though, in an era of mobile banking? And this has been a big question, just underpinning some of the angst around regional banks.
I think a lot of people really are worried about their bank and can they get miles on the United Mileage Plus account or whatever. You know, pick the mileage thing. I think we're living in Tim Adams.
Exactly.
You know, when Tim Adams comes in the room, it's like Henry Clay. I mean, it's like the 19th century walks in the door. And frankly, in Diamond's letter, he alludes to this. We got to drag our sorry selves into the 21st century of banking, where Brammo's going, now, can we get miles? If we buy this through the bank, can we get 30,000 miles?
Why are you pitting this on me?
It's on everybody. It's everybody, Lisa.
No kidding. United, seriously?
United.
And you're going to put
United
that on
is
me?
a big thing.
It could be United, it could be Chase, it could be whatever.
That's
I don't,
good.
name your bank.
Good for you to name other
You know,
institutions.
I've got my TOTS vanity card.
Okay.
It's got Harry Kane's on the cover of it. It's really good.
That's cool. Okay.
Yeah.
Anything else? No? Done?
The number?
Thanks.
Amy Wu Silverman of RBC is going to join us because CPI comes out in about 1 hour and 34 minutes.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
So can you talk to us maybe about like how important data targeting or targeting of an audience actually is? Because I think we hear these things like, oh, it makes it harder for advertisers if they're not able to track your data. Why is that so important? And like, can you maybe give us some numbers around how valuable a targeted ad is versus an untargeted one? I don't even know if untargeted ads exist on the internet anymore.
Oh yeah. Well, and just on to sort of add on to Tracy's question, like let's say I go to golf.com. Yeah. Okay. The ads that I get, like how much is it? Oh, he's on golf.com. He probably wants to read about golf, as opposed to ads that I get that maybe, the last 10 sites I went to is like pets.com or something like that. Yeah. And so how valuable is it for golf.com to be able to know that I also like pets?
I mean, there's all sorts of open and maybe unsolved questions about the value and precision of online advertising. The classic example is like you go and you buy a pair of sneakers and then all you see are ads for the same exact sneakers, like just following you around the internet, right? It's like, I just bought these. Why do you, like the world's biggest tech companies that so supposedly know a lot about you, like can't solve that problem.
You bought one pair of sneakers, you must want
want
more.
another one, right?
Well, I do, but I definitely don't need a second stone.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Was going to keep rating World Cup.
This is a 3 as the economic picture does.
The OK is getting ready to make a decision.
In Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
The banking crisis has been contained, given that there's good access to liquidity in the strongest banks.
Unfortunately, there's more downside in the equity markets than there is upside today.
You need people to stop spending, you need credit to contract, and that's what slows the economy and brings down inflation.
The Fed wants to hike probably once, maybe twice more, but it's really torn because it's got these obvious troubles.
I think the landing could be quite a bit harder than many are discussing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from Washington, D.C. for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and on radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow in the nation's capital for the IMF World Bank spring meetings with you for the next several days from Washington. Equity futures right now on the S&P 500, just about positive on the S&P as we continue to count you down to the inflation report in the United States of America. That print 90 minutes away. After CPI through the rest of this week, the attention shifts to bank earnings in America. Tom, but first of all, 90 minutes away, we've got to deal with inflation up front.
Key CPI data, split it between core and headline. The adults are focusing on core. That's what we'll do, obviously, at 8:30. But there's much more than that. I love David Rosenberg's work in Toronto of parsing the inflation analysis into 20, 30, 40 lines. That takes time. We're not going to do that. Even Mike McKee can't do that at 8:31. But the idea of looking at the subsets of inflation will, I think, be very rich study.
And then, Lisa, just on the horizon, in the distance, May 3rd, the Fed's next big call.
Yeah, how do they even weigh all of these data points, right? I mean, and we've talked about this, the subjectivity of data. So you could say you're data dependent, but what does that even mean when you can choose the data that you want to fit the narrative that you'd like to put out there?
God, I miss the cynicism.
Well,
I'm sorry.
Cynicism is just facts, So you can talk about the CPI.
I happen to agree with you.
Well, thank you.
Wholeheartedly.
I mean, honestly, today's CPI data, you can color the way you want. Perhaps, maybe we'll get an absolute read, hot or cold. But there's a question of where is the trajectory when the world changed with SNL, given what happened with Silicon Valley Bank and given what happened going forward. And this really is the angst underpinning the market and underpinning the Fed.
This phrase, data dependence, has become a crutch. It's how you don't answer questions. Well, we don't know where things are going. We'll be data dependent. But ultimately, the real question, Tom, is what data are you dependent on? And how much weight would you put on traditional indicators, CPI, GDP, NFP, payrolls?
Yes.
And how much weight would you put on these new indicators we've become very focused on? H8 data from the Federal Reserve and what's happening with bank lending.
I would parse this into a financial study, a real economy study, which we spend way too much time on, and then also now a bank financial study. So you have three broad narratives bouncing into each other like a proverbial Venn diagram, and they're dynamic. They change day to day. We need information on the real economy, we need information on the core financial data, and we need information, as you mentioned, on Federal Reserve details of the bank deposit flow.
The totality of the data, and hopefully we get some information, some clarity from the banks themselves. JP Morgan reporting earnings on Friday. We were due to have some earnings from First Republic tomorrow on Thursday. We're not getting them on Thursday anymore. April 24th for the First Republic earnings report. Look out for that. I want to give you just a quick snapshot of the price action, and Lisa can give you the day ahead in just a moment. Equity futures right now positive by a little more than 0.1%. No drama here whatsoever. Yesterday was a total snooze on the S&P, closing totally unchanged. Yields just a little bit higher by a couple of basis points. 3.44 on a 10-year maturity. Just on a 2-year, Lisa, back above 4%, just higher by 3 basis points again at 4.05% this morning.
The tension of the possibility that the Fed is likely to hike on May 3rd, a 75% chance priced into the market, with the reality that this is a very quickly moving economy that is hard to see. 8:30 a.m., we try to get some visibility with U.S. CPI. There are two main components, I feel like, right now to the inflation discussion. There is the inflation readings, And then there is what's going on with respect to banking stress. This is one of them. Does this get upended by what we get starting Friday? Core is going to be key. 5.6% is the expected year-over-year number, up from the February read of 5.5%. How much does that really color the conversation when you strip out the more volatile food and energy categories? 10 a.m., the Bank of Canada. Tom was talking about moving to Canada and the Canadian banking system. I'm curious about their rate decision. They could potentially hold rates at 4.5% for the second straight meeting, moving against the ECB, moving against the Federal Reserve with a pause. What is the consequence of their signaling? How much do we see the market push back against that? And if there is acceptance, does this give a green light to the Fed to do the same? 2 p.m., FOMC meeting minutes. This is going to be really interesting because we're going to get a sense of how visceral the debate was between people saying the credit crisis that you're seeing with respect to Silicon Valley Bank is material and we need to respond to it by pausing, and how many people come out and say, ignore it, it is noise, let's go forward for the 50 basis point. How much was there a consensus around the 25 basis point that they actually got through? We do hear from Tom Barkin today and Mary Daly, both of the Fed.
Would you move to Canada?
I would, but Luke Kawa joined UBS just so he could get their Maple Leafs tickets.
Is that right?
Oh yeah, that's why.
I didn't realize you were talking about moving to Canada.
It's sort of like England. There's like 5 big banks. That's it, and they're not in crisis. It's a really interesting debate, and a lot of people use Canada as a model that may be efficient and successful.
Elisa was talking about sending you to Canada.
I did not say that.
Well, I'm not going to Montreal because the Canadians are an embarrassment, but, talk to Rosenberg.
Okay. Amy Silverman joins us now, Head of Derivative Strategy over at RBC Capital Markets. Amy, wonderful to catch up with you, and welcome to the program as always. Amy, is this the calm before the storm?
I think so. I think it is. And for what it's worth, Tom can visit Toronto with me anytime, as I have to go there quite often. But, look, I think it's a bit of the calm before the storm because obviously we have CPI quite shortly. And then after that, we have earnings. And, the volatility right now, we have a sub-20 VIX is reflecting a little calm before the storm. I think that changes quite quickly. And I think if you actually get a cooler CPI and volatility comes down even further, that's probably an opportunity to buy because historically, the first few weeks of earnings is a great time to own volatility.
Amy, I want to go narrow with you on your expertise on the cross moments, and particularly this strange thing called skew. We're talking to Lisa Abramowitz about her newsletter. We're going for a toxic brew. I want to talk about a toxic Apple skew. Everybody's on board, big tech, and you're looking at their derivative dynamics. What do they say about the future of a big tech rally, a toxic Apple skew?
So, I'd say 2 things are really interesting right now in the options picture. The first is, while option prices are kind of high in financials, that skew is quite low. It is not showing any more bearish sentiment. You're getting exactly the opposite picture in big tech. So the option prices are not nearly as high on a relative basis as financials, but that skew is very expensive. There is that demand for downside. A simple explanation is people just have made a lot of money in tech so far. It's been this safe haven trade. So, of course, more demand for hedges. But also, it could point to further bearishness, particularly on earnings, where you start to get that new information. And remember, if Apple goes down, if Google goes down, if Meta goes down, the overall market goes down with it.
Amy, what's more important for you this week? Is it going to be what we get today at 8:30 a.m. with the CPI report, or is it going to be JP Morgan earnings kicking off on Friday?
I think this is probably the one time where I would say it's these financials earnings specifically rather than CPI, which obviously has been so core to everything. But people are really going to be hanging on the words of every management team. JP Morgan, the large banks, obviously, but also the smaller regionals where when you kind of look into the derivatives market, again, that options positioning is still showing a lot of magnitude. So those implied moves going into earnings, SURP on the terminal, is showing you that we're still pricing nearly 3 times the expected move that you see over the historically last 8 quarters of these companies.
So how do you translate this into an equity call, bullish, bearish? We try to take the blunt tool of what this means for Fed rate hikes or not. But from your vantage point, if we find out and get a confirmation that we did see deposits tumble by the most in more than a decade at the biggest banks, as some people are expecting, or that there is a massive restriction in capital creation, how much does that color your view, make you bearish on certain sectors, push you toward others?
You know, look, the two most popular questions I get around how to structure trades is the first one is, how do I play a rebound in the regionals through KRE? And the second is, how do I hedge tech? And, you know, those are the right now. We look at KRE call spreads. We're looking for QQQ put spreads. But essentially, when you lead that back into equities, it's this question of an inflection point. Does this quarter become an inflection point? And if it does, what optionality is the best way to play that?
Amy, wonderful to get your thoughts, as always. Amy Wilf-Silverman there of RBC Capital Markets on the calm before the storm, the calm before CPI, the calm before earnings later on this week. And that's another guest that has suggested to this market, at least right now in this moment, that maybe the earnings from the banks, Lisa, more important than the data we've received on Friday for payrolls and CPI a little bit later this morning.
We were just talking about the importance of regional banks, and Jim Bianco pinged me over at Bianco Research and pointed out why it is so important to watch the health of these regional firms, that the majority of the workforce in the U.S. is employed by them, number one, and the 4,200 regional banks are best structured to meet their needs, and that let's say you get them to disappear. What happens? Do the big banks beef up in specific towns in Cincinnati and Toledo and basically go and try to serve all of these commercial realtors as well as all of the other businesses? Or do they just not get access to funding?
People were watching in Cincinnati going, Brammo's conflating Cincinnati with Toledo, the Reds with the Mud Hens? I don't think so.
Thank you for that insight, Tom.
Thank you.
You get smart comments on the Bloomberg. This is what I get. To be clear, he won't come south of 50th, but he'll move to Canada. That was a message that I got on the Bloomberg terminal about you moments ago.
Just to give you a little vignette on this, I used to buy my hockey sticks at Maple Leaf Gardens just because it was cool. And to go into the old Maple Leaf Gardens, John, and stand on the top, I'm sure there's an English equivalent. It was like St. Peter's in Rome. It was the old.
That's what it meant to you?
Sitting at the top, looking down on that Canadian history was just, I can't say.
It's like me at the San Siro
I'm sure there's
in Milan.
Yeah.
Same thing.
I
just feels, you know.
So. That's before Zava went to AFC Richmond, but that's a different story.
Yeah. Okay, thanks for that.
Thank you.
I'm picturing him at the dinner table being like, this is like Rome, listen to me in my proclamation, and everyone just sort of shrinking.
Is that what dinner time's like at Kazakhin?
Kazakhin, dinner time.
Right? Do you sit around the table together?
And argue like cats and dogs. Yeah. Argue. It's very constructive. I mean,
That's what we did. That's what we did as children. Like yeah. But then there was a cut-off. It wasn't allowed to carry on through the night. Only at the dinner table. It couldn't carry on to the following morning. You had to, let it go. Let it go. Absolutely, you had to let it go. Then you started again the following day.
Exactly. What does it mean to let
at
it
the
go?
dinner table?
Exactly.
About yesterday, futures on the S&P.
Is Toxic Brew winning on the newsletter?
Positive a 1/10%. We should do a survey ourselves, a poll. Yeah. Let's do a poll
that's a great idea.
On names for it. Okay. From Washington, this is Bloomberg.
Kazakhin. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Biden administration is proposing a tough crackdown on auto pollution. Tailpipe emission limits will be so strict they will compel automakers to ensure 2 out of every 3 cars sold in 2032 are electric models. Still, there's questions whether car companies can fulfill the fleet-wide limits on carbon dioxide and smog-forming pollution. In other news this morning, officials in the Fed, they are signaling that there's a divide over raising interest rates. Well, New York Fed President John Williams says there's still more work to be done to bring down inflation. Meanwhile, Chicago Fed President Austin Goolsbee became the first official to suggest that policymakers may need to hold off on further hikes for now. We get the latest numbers on consumer prices at 8:30 New York time. Donald Trump wants a 4-week delay in the start of a civil trial over his alleged rape of author Jean Carroll. Now, his lawyer says a cooling-off period is necessary following his indictment in the case of hush money payments. The trial in the Carroll case is due to start April 25th. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Wall Street prepares for the latest read on inflation.
The inflation report is going to be very important.
Inflation is slowing, but the Fed has more work to do.
We have this huge disconnect between where the dots are and where the market is.
The Fed's saying one more hike. The market says 100 basis points of cuts.
Instant reaction on Bloomberg surveillance.
Can you establish disinflationary vectors in goods and services?
And what it means for the Fed.
They're moving data point by data point.
Is this basically just whack-a-mole?
Inflation in focus. Today on Bloomberg.
So I've not really seen evidence at this stage suggesting a contraction in credit, although that is a possibility. I believe our banking system remains strong and resilient, so I'm not anticipating a downturn in the economy, although, of course, that remains a risk.
Welcome to the world of politics. Janet Yellen, the U.S. Treasury Secretary, yesterday saying, quote, "I've not really seen evidence at this stage suggesting a contraction in credit." Yet on Friday, there was exactly that. Lisa, evidence of a contraction in credit. What did you make of those comments yesterday?
I viewed it as a political kind of speech. And I view this also as her trying to parse out how much to fortify confidence in the financial system rather than reintroduce more risk. I did not view this as an accurate assessment of where we are or some sort of signaling. And I don't think anyone did. No one came away from this and said, all right, it's all clear. I guess we can
I agree with the Treasury Secretary. The U.S. economy is doing exceptionally well as banks fail weekend after weekend over the last month.
It's not just the bank failures. It's also the fact that you saw the biggest 2-week contraction in commercial lending. Ever. I mean, that basically speaks to something.
And yet, Tom, she does not see signs of a contraction in credit. No evidence of it.
She's not like a normal Secretary of Treasury. We forget that Mnuchin, Hollywood producer, wheeler-dealer guy, is far more towards maybe John Connolly of Texas in the 60s. Yellen is a real outlier. And when you hear a speech like that, she's still struggling with how do secretaries of Treasury actually convey an administration
Did you
message?
just call Mnuchin a wheeler-dealer Hollywood guy?
He's a Hollywood guy. You know where I first interviewed him? He was
a dealer,
John,
Hollywood guy.
When I first interviewed Mr. Avatar, he was in an art gallery.
Oh, he's Mr.
in the
Avatar now.
Hamptons.
Okay, wonderful.
Yeah, he's a great guy. And may I say, he really grew, and he really got used to the Treasury dialogue as they went from crisis to crisis in the Trump administration. First time I interviewed Steve Mnuchin was on a summer afternoon in a Hamptons gallery. I mean, that's not like Janet Yellen.
I understand he tunes in time to time. Good morning, Secretary Mnuchin. I wonder what he thinks of that.
I don't know. I didn't watch the new Avatar.
It's really good. I liked it.
Did you like it?
Yeah, it was really good.
I watched it. It's just too long.
It's like 4 hours long.
Whatever. It took 2 hours to get started.
But it was good, though, no?
Yeah, it was good.
Okay.
But it took 2 hours to get going.
All right, fine.
It's just.
Are we ready?
Yeah, we are. We were ready a few minutes ago.
And this is going to be really, really interesting. I'm serious about this, and that we have John Farrow here, who is posh and living in the United Kingdom.
So
and
posh.
Anne-Marie Horgan joins us now, Bloomberg social correspondent here. And there was a president getting off the plane. I saw Phil Mattingly on CNN going back to the mother country to see the president in Ireland. Explain the distance.
He's in Northern Ireland.
Okay, Northern, Southern, Western Ireland, I don't care. The answer is the distance.
There's a big difference.
The difference from Dublin to Liverpool is 117 miles. But the cultural difference is he meets with the Prime Minister of the United Kingdom. Ireland, United Kingdom, and a kid from Scranton. There's a real toxic brew here, isn't there?
There certainly is. And if you look what members of the DUP of Northern Ireland are saying, is Arlene Foster, a dame, is coming out and saying, current U.S. President Joe Biden is anti-British. And that's why you see the White House head for National Security Council of Europe, Amanda Sloat, saying he is certainly not anti-British. There's a deep connection between the United States and the U.K. The president wants to make sure he's growing this relationship, and he's here to mark 25 years of the Good Friday Agreement and to have discussions about Ukraine and the economy with the U.K. and the U.S. But the heart of it is that this is a president who likes to talk a lot about his Irish roots, and most of this trip is actually him placing back his lineage. And he's going to be almost on a family tour after he meets with Rishi Sunak and gives a number of speeches and a number of meetings with party leaders.
What's he done to grow the relationship with the UK?
Well, that's a great question, because the UK really wants right now a free trade agreement, and that has been on ice since the Trump administration.
That's been pushed back again now, right?
Yes. And Jonathan, you know this very well, obviously. When Brexit was being hallmarked in the United Kingdom, the crown jewel of that was going to be a free trade agreement outside the European Union with the United States, and the U.S. has not delivered at all on that part of the bargain.
Why?
Well, there's a number of reasons why. It is just not a priority, though, for this administration. It is not a priority to have a free trade agreement with the United Kingdom. For the UK, the U.S. would be a huge win, but for the U.S., is the United Kingdom that massive of a trade partner? But it is an important relationship. To the White House's defense on this matter, Amanda Sloat had said Rishi Sunak, the UK Prime Minister, will be coming to Washington in June, and that's where they'll be discussing more economic issues like a free trade agreement.
Are they going to discuss the comments from Macron over the last week?
Well, that potentially will be one. We already heard Liz Truss, the former UK Prime Minister, coming out and really having her own view on that, pushing up against Emmanuel Macron, who's taking a lot of fire right now, not just from U.S. politicians, but politicians in Europe. But also another huge point, not just Macron, but these leaked documents. Yeah. This is going to overshadow every meeting the President of the United States has from here on, at least the next 6 months.
Well, that's where I wanted to go, actually, because we see dueling reports, some people saying we don't know yet, this isn't clear, to see what the extent of this is and how much this could potentially disrupt relationships. We've seen South Korea come out and reaffirm the strength of the U.S.-South Korean ties. How much in closed-door conversations has this disrupted the willingness of allies to share information?
Well, they're concerned not just about sharing of information, especially when you look at the Five Eyes and these intelligence groups, but also the fact that the United States is once again spying on allies is a concern that you hear foreign officials talk about. The one thing you don't see is it's not happening so much in public. These conversations, allies are using back channels to air their grievances, I would say, with the administration. They're not doing it in public. South Korea is an interesting moment, though, because the head of the country will be coming to the United States for a state visit, but the opposition is saying the U.S. is infringing on our sovereignty by spying on us. So it's a difficult moment, and what these leaked documents have done is put these leaders in very difficult positions as they're dealing with the White House.
The public comments have been, we're investigating, we don't know everything yet, just wait, nobody's waiting. When they talk to the actual, the allies, what kind of guidance do you hear them giving in terms of what their understanding of who leaked the documents when and how significant the leak is?
We just don't know yet. And I don't think they actually even understand how significant the leak is, because the comments, and we had the first comments yesterday from Lloyd Austin, the defense secretary, the first public comments, they're pretty muted and they don't give much details. And it's pretty much like, we are waiting and we'll update you when we find out more.
Is that because they don't know?
I think that's a number of reasons. They probably don't want to come out yet until they have all of their ducks in a row, and they probably still are investigating it. But
I get
said
the
they'll
feeling
get to the
they just
bottom of it.
aren't really aware of what documents are out there at the moment.
Well, I guess the concern is, is there potential for more documents to be leaked? How can they come out and say, we've put this to bed, we've wrapped it up, and then potentially they can get slapped in the face?
AMH, thanks for having us in Washington.
Oh, thanks.
Appreciate it. Thank you. Thank you. TK, what a saga for this White House right now.
It is. Well, the leaks, I'm with Anne Marie on this. It overwhelms every discussion. I mean, I can make jokes about Brexit and British tariffs like on Walker's shortbreads. That's a scandal what I have to pay.
Is there a tariff on
that?
that?
Free trade agreement.
Didn't know that. Wow.
You know what? Jokes aren't in place here. This is really serious stuff. I believe we have General Kimmett coming up on this in a bit. But to Anne Marie's point, you just go and let it phase out because you don't know what the next document or next event is.
You joke about food tariffs, shortbread, but actually food standards is the big issue if you ever wanted to come to some kind of free trade agreement with the United States.
I don't mean to make little of it,
These standards are a little bit more, let's say, robust in the United Kingdom around food.
A discussion around UK tomatoes and their eggs.
It's more like
it's
about what you do with your chicken and stuff like,
you know, how good.
I know, we're not going to have a conversation about that. No, they just are. You know, that's not really a conversation. That would end pretty quickly.
Okay, we're just going to stick barrier here.
Adam Posen's going to be joining us shortly of the Peterson Institute for International Economics. I'm looking forward to that conversation. He's here in Washington alongside us in about 5 minutes' time. Equity futures positive by 0.1% on the S&P 500. Yields unchanged on a 10-year. CPI data, the inflation report, 64 minutes away.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
I always say the greatest quotes are in the commercial break, but I won't share them.
On it, like the sports
We should one day. From Washington, D.C., this is Bloomberg Surveillance, 60 minutes away from the CPI report, the inflation report in America. Going into it, your equity market shaping up as follows on the S&P 500 and on the NASDAQ. The NASDAQ is just a little bit softer, weaker yesterday too, down by 0.1%, firmer on the S&P, up by a little more than 0.1% on the S&P 500. Pretty muted price action going into another important read on inflation. Then on to earnings in America with JP Morgan reporting results on Friday. In the bond market, the 2-year reclaiming 4%, a 4 handle on a 2-year yield, 4.0372%. Yields just a touch higher now by a basis point, a little more than a basis point so far this morning. To look over to Europe, remember May 3rd for the Federal Reserve, May 4th for the ECB. The May 3rd rate hike from the Federal Reserve could get rubber stamped a little bit later this morning. Barring any more banking stress, 109.27 is where euro dollar is, firmer by a little more than 0.1%. Tom, let's say slightly stronger euro this morning, a weaker dollar.
Huge debate on a weaker dollar, of course, an interest rate dynamic. We heard Ibrahim Rabari frame out not months, but years out, very tentatively, but with respect to where could we be 3 to 5 years out. And he's modeling stronger yen 110, perhaps modeling stronger euro 130. These are big moves, but it's what the financial media doesn't do. We look short term, 1 quarter, 2 quarters, maybe a year out. 1 week, 2 weeks. The adults are looking out 3 years, 5 years.
Lisa promised to pay for dinner later. And for that reason, we have to promote her newsletter. Subscribe. Subscribe. How many times do I have to say subscribe? Just subscribe.
You're doing great, by the way. She bribed me. All right, fine, I'll get this done.
Bloomberg.com/surveillance for the Bramo Toxic Brew, the Daily Toxic Brew, which I think is going to work, and we're going to rebrand that without Lisa knowing about it.
I think that if I don't know about it, I'd have to have my head in the sand. That's all I can say, because I think you've telegraphed it just fine.
There we go. I think that works, Tom. Looking forward to the latest edition.
Today. Yeah, and there will be comments today with our next guest. Adam Posen with us, and it's always an annual visit at these meetings of the IMF and the World Bank. He's president of the Peterson Institute of International Economics. He is, without question, with Richard Clarida, one of the leaders in thinking about Germany in the United States of America. Dr. Posen joins us this morning. John's going to talk to you about your wonderful essay on the simplistic static analysis of manufacturing in America. I want to go to the mathiness you learned. You were at Brooklyn High School a million years ago, and they said, don't look out 5 years. And then you went off to undergraduate. Don't look out 5 years. Then you did your PhD work, and they said, don't look out 5 years. And here's the International Monetary Fund with a 5-year model of 3% growth. Can people like you look out 5 years?
We can look, but we may not see. I think, Tom, the IMF is making a judgment call, which is within their rights. And I think it's a reasonable judgment call, but unfortunately, I think it buries the lead, which is that we're going to get a goosing of short-term growth in the large economies, in the U.S. and China, in Europe, because there's going to be public spending on defense and on green. And there's going to be a continued falling off of growth in the poor economies, who are going to be forced to choose between U.S. and China and for reasons. Very good report put out by the IMF recently. I know you covered. Very good report by the World Bank recently. You've covered my stuff. The spillovers on growth for the developing world from the U.S.-China conflict and the subsidies race between Europe and U.S. is very bad.
What to me is critical here, and David Folkerts-Landau of Deutsche Bank with some serious publishing with Dooley years ago, echoed what you said the day after Putin invaded Ukraine. So if we have the fiscal stimulus that Dr. Folkerts-Landau is talking about, you're talking about right now, and we dovetail that into your colleague Olivier Blanchard's phrase, fiscal space. Does the United States or Bolivia that we mentioned the other day, do they have fiscal space to act given the present traumas?
So you may have seen I hosted a debate or a conversation between Olivier and Larry Summers on PIE.com a few weeks ago on this very topic. And where Olivier, Larry, and I, more importantly, Olivier and Larry came down was that this kind of sustained fiscal expansion and possibly some inflation premium that continues going forward will decrease the amount of fiscal space. Olivier's fiscal space, rightly, is about the gap between real interest rates and real growth. And that's been very large for a long time. This is probably going to cut that by a third to a half. That doesn't mean the U.S. doesn't have fiscal space, but it means that we're more at risk than we've been for a very long time, and a bad shock to productivity, to revenue, or to interest rates could put us quickly into bad space. But additionally, if R-star, the shorthand for this, basically goes up, meaning that the gap between interest rates and growth shrinks, the Bolivias, the Sri Lankas, the Pakistans, lots of Central America, lots of South Asia, lots of Africa, they lose fiscal space.
When you have these discussions, is there a tipping point for 10-year yield, say, for borrowing costs in the United States, after which the current fiscal model becomes untenable?
Yes and no. Sorry to do it that way, Lisa. The yes is you can do some very fancy mathy stuff. Jeremy Zettelmeyer, now the head of Bruegel, who used to be at the IMF, and Olivier and others have worked on this, and you have to do simulations. But cold bottom line, the odds of your tipping go up, and probably go up non-linearly the closer you get to R minus G being zero, because this is the math. I mean, the basic math. Once you're above, once that R minus G turns positive, meaning interest rates are outpacing growth, that's when the bad debt dynamics kick in. That's when, if you have debt to GDP, it's over 100%, it kicks in. Now, it's not a tipping point that happens, going back to where Tom started this week, this month. Maybe for Bolivia, not for the U.S. But if that turns out to be the case, that being rates above growth rates for 6 months, a year, then you start getting serious.
The bad politics has started. You mentioned that, the subsidies race between Europe and the United States. I still don't think this is getting enough coverage. You said it's very bad. Can you paint a picture as to why this is so bad?
So, as it happens, Olivier and I and some of our trade experts from Peterson, Chad Bown and Jeff Schott, were meeting with a European finance minister last night about this very issue. Basically, the problem with subsidies in trade is that it ends up being not just wasteful, that's bad, but as I've tried to argue in my article, and as history shows us, it escalates very quickly. And this is what we're seeing. The U.S. puts out this IRA, which includes huge subsidies for particular companies, not just subsidies for green tech, not just subsidies for R&D. That would be nice, but subsidies for particular companies on a criteria of they have to be producing in the U.S. and mostly they have to be U.S. headquartered. And so then Europe says, okay, well, we'll do subsidies in retaliation. And then the UK says, already has, one of the opposition politicians, Miliband, came out and said, you know, we got to keep up with this. We're not going to be left behind. We had the Indian finance minister at PIE on Monday, and she said, we're going to do subsidies. And so what you end up with is like an arms race. Everybody builds up. Nobody gains economy of scale. The competitive basis for having the winning company, say based on better technology, more efficient processes, doesn't win because you're subsidizing here and you're subsidizing here. And France says, we're not going to buy American, and America says, we're not going to buy French. And so you end up with this huge on-balance sheet obligation to the fiscal, to go back to where Lisa was. And one of the worst things about this is open-ended. So the way the U.S. passed the latest round of subsidies, it's driven by the consumer It's how much you produce. It's not, oh, we're going to get to this level. You produce more, you get more subsidies. So this becomes a fiscal issue as well as you run in place to just get to the same spot. And then finally, it's totally discriminatory against the rest of the world because basically China, the EU, and the US can afford to do this. India can pretend to afford to do this. UK can pretend. And the rest of the world, you're out of luck.
It's done under the guise of supply chain resiliency.
Yeah.
And these phrases get thrown around and they take on a life of their own. It's almost just the truth. You have to get more resiliency into the supply chain, and that means you have to bring it home.
Yeah.
You've dismissed that straight up. I think you've said it's proven to be a fallacy through economic history, and I can think of several failed socialist communist states that have tried to do the same thing, and it's difficult to do. Is the United States, Europe, China, even if they have access to the funds, they can afford to do it? Who says it's going to be a success?
Well, thank you. I agree. You know, there is a legitimate question to be raised as private supply chains have risen organically. Individual purchasing managers saying, I got an order from the CFO to cut costs 10%, so I'll outsource this. Oh, I've now outsourced this, so I know somebody else. You know, there's a reasonable public policy interest in saying, let's not overdo that. But that's very different from saying bringing it home is safer. You know, it's the same logic as your investor watchers say. Diversification matters. I think you mentioned all the communist countries. This is part of what I've been arguing. I mean, you look at Russia. Russia has spent 20 years trying to make itself self-sufficient just so it could go do things like invade Ukraine and not worry about it. And like the U.S., like China, it's huge, but it still doesn't work. It ends up backfiring. You end up with a corrupt industrial complex that doesn't give you what you need.
John, British headline, 2012, 11 years ago, business group economist to replace Archdove Posey at Bank of England. Do you have any advice, former MPC member, for Megan Green as she is anointed to, there'll be a coronation as she moves to the Bank of England?
Oh, I hadn't heard the news. Congratulations to Megan. That's great. You know, the external members, including Catherine Mann, my former colleague, who's now one at the Bank of England, have a good record of genuinely giving independent thought. And you mentioned me as being characterized as the archdove a decade or 11 years ago. Of course, now I'm considered a hawk because I'm telling the Bank of England, you guys are whistling fantasies. Inflation's not coming down. So be data-driven, and everything will be okay. But I hadn't heard about Megan. That's great.
Adam, the external model at the Bank of England on the MPC, it's different to, say, the Federal Reserve. Why is that so important, and what lessons can we take from that? Mohamed El-Erian was talking to Tom and I about this on Friday. He said that the MPC model of having external members is helpful. Do you think it is?
I think it is. I fear it's not as helpful as it should be because sort of you look back at what the Bank of England has done or others with an external model versus what the Fed has done, and the differences aren't as great as I would like to think. But I do feel it's been important for the bank, both in terms of legitimacy, just that you end up having more split votes and more open discussion and debate, which is better for the public sense that this is hard, but they're taking it seriously. And occasionally you get things right a little faster because the external member's squeaky. You used to have, and still probably do, my former colleague Danny Blanchflower, who was quite squeaky, but also...
Blanchflower was the worst since Henry VIII, I think.
But he, in this particular instance, he was right. And I think history has shown I was probably right on some of the stuff I squeaked about while I was there. So it's useful.
Adam, a clinic, as always. Thank you, sir. It's good to hear from you. Adam Posen there of the Peterson Institute for International Economics. Live from Washington this morning. Good morning. Inflation data in America just around the corner.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Last month, policymakers shrugged off bank failures to deliver a 0.25 percentage point rate hike. Today at 2 p.m. in Washington, we find out the thought process behind their decision when the Federal Reserve releases minutes from that meeting. The March rate hike brought their benchmark rate to a range of 4.75 to 5%. China indicated it will maintain pressure on Taiwan following its large-scale military drills. The maneuvers began after Taiwan's President Tsai Ing-wen met last week with U.S. House Speaker Kevin McCarthy in California. A Chinese spokesman said, quote, "We will not leave any room for any form of Taiwan separatist activities." Senator Tim Scott of South Carolina is one step closer toward challenging Donald Trump for the Republican presidential nomination. And Bloomberg's learned that Scott is launching an exploratory committee that would allow him to start raising money for a campaign. He's visiting several early voting states this week. Bed Bath & Beyond says it's raised more than $48 million in an equity offering as it tries to avert bankruptcy. Now, the home goods retailer's goal is to raise $300 million by April 26th. Shares have plunged in recent weeks amid growing pessimism about the Bed Bath & Beyond's outlook. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors who learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Hi, I'm Francine Lacroix. Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet. Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Fragmentation risks have risen quite sharply over the last 5 years and have been accentuated by the war in Ukraine. If those risks rise, then Asia risks to lose the most among all the regions in the world.
That was Krishna Srinivasan, the Asia-Pacific director at the IMF. I have to say, I have to keep going back to this. The IMF commentary of the last couple of days, so gloomy. And we can pick up on some of that for you through the week as we cover the IMF World Bank spring meetings down here in Washington, D.C. Also staying on top of the data, the CPI data, the latest report comes out in about 43 minutes' time. Going into it, equity futures, Tom, still positive by 0.2% on the S&P 500. Yields just about unchanged on a 10-year, 343.93.
Right now in Washington, in the IMF spring meetings, we digress. Joining us now in his Washington is General Mark Kimmett. Yes, the former Assistant Secretary of State for Political and Military Affairs, but he's been a terrific advisor to Bloomberg surveillance on the complexities of military in this modern era. General Kimmett, thank you so much for joining Bloomberg surveillance.
Thanks, Tom.
Today. I want to go right now to something dovetailed. It's a bit off the script here of the themes out there, and I think it's been ignored in the American press. We are reaffirming our position in the Pacific Rim by a $100 million 12-month capital commitment to the Philippines in 4 Navy Army bases. I think most of America is ignorant of the Army commitment in World War II, what happened north of Manila, the bravery that was done there. And what I'd like to know from you is the importance of this projection by the Pentagon to a new Pacific Rim strategy, Army and Navy.
Look, I don't want to sound trite, but you and I, Tom, grew up when the Iron Curtain was up. I think this generation is going to be growing up with the bamboo curtain. We're setting a curtain that ranges from Korea to the Philippines to Japan down to Australia to try to contain the hegemonic behavior of China militarily. Cooperation and competition going on economically, but there is a significant concern about the hegemonic aspirations of China, and that's what the military is setting up.
Our guests talk about a substantial increase of Pentagon spending to GDP. You're the best general we have linking in financial matters. It's widely understood that Kimmett owns the high ground there. Do we have the will to expand Pentagon spending to GDP?
Well, I may know a lot about the military, but that's more of a political question. The issue is, can the president, can the Pentagon make the argument to Congress and to the American people that raising of GDP is necessary at a time when, quite candidly, the federal budget is under significant duress from other expenditure programs, entitlement programs. I hope they do. I think it's necessary, but that's a tough sell to make these days.
General, I keep going back to what Peter Cheer, a commentator, said on this show a couple of days ago, when he said that this is probably the most perilous and fraught moment geopolitically that he's experienced, and that his generals who work with him, his former generals, have experienced in a very long time. Do you agree? And is it really focused in China, or is it broader?
Well, first of all, he must be quite young, because the threats that we faced when I was a young officer were far more significant, whether it was the Soviet Union, the impacts of the post-Vietnam period, the Russian-Soviet interference in both Africa, Latin America, Central America. There were a significant number of challenges there, not to mention we had a population that was absolutely unsupportive of the military writ large. Yes, we have challenges today, but I'm convinced that the U.S. military is up to those challenges, whether it's the Army, Navy, Air Force, or Marines. We need to modernize, we need to expand, but our soldiers are ready.
How does that dovetail into the leaks, the national security leaks that we've seen? Perhaps the military is ready, but is the intelligence infrastructure, is the cyber sort of security in place to really support them?
I certainly hope so. I was never concerned about the intelligence products that we were getting from DIA, the human intelligence, the signals intelligence, the military intelligence, cyber. I think we're at a situation, Lisa, where we don't know what we don't know. But the fact that Russia has not been able to execute a successful cybersecurity operation against Ukraine, I think tells everyone that we're probably ahead of where we should be. I'm just not competent to answer that question.
But the bigger takeaway for a lot of people is that the U.S. is spying on its allies.
As we always have.
Right. So this is sort of not a surprise, and perhaps shouldn't be. But that also that the U.S. could be a sieve, right? That there could be breaches here if other countries share intelligence. How concerning is that to you? How much is that what you're focused on?
Yeah, that's probably the most important issue there. The issue of allies spying on allies, I mean, that's something that's understood. This is not a surprise. It's just an embarrassment when it gets into the general public. With regards to your other questions, particularly what we call the Five Eyes countries that we share with, that is a significant threat to the relationships because, very simply, it reduces the intelligence flows. The other countries are much better than we are in certain areas, but if they don't want to share it because they can't trust us, that's going to have a ground effect.
I want to talk about the United States allies. Europe has been a weak link when it came to Russia over the last decade, particularly Germany. Germany was warned time and time again about the energy dependence it had on Russia and didn't do enough to back away, and we've had to deal with that in the last 12 months. Now we're dealing with China, and some people might make the same accusation that Europe, once again, is a weak link, and I would bring up the comments from the French president, the French leader over the last week, and as an example of that. You've talked about the hegemonic aspirations of China and the risk around that. For the United States to be an effective hegemon on the global stage, both willing and able, it needs to bring its allies with it, the Europeans. Are you seeing much evidence of that when it comes to China?
Well, with regards to China, I'm more concerned that the relationships we have are the strong links with Australia, Korea, Japan, the Philippines. That's the front line. The supporting line comes out of Europe. So while Europe is important, particularly with regards to the economic cooperation or economic enforcement when China violates WTO, I'm more concerned that we've got it right with the allies on the front lines, and then those in the second tier, the Europeans. That's important, but less important.
Give us a window into China. Stilwell was over there a long time ago, and it was basically total chaos. Marshall, retiring, had to fly over there on an emergency basis and try to figure out the new China. Has anything changed in 70 years? Do we have an intelligence basis there where we can be more confident of our actions? Or is there that cacophony that Stilwell and Marshall faced?
Well, first of all, I'm not an intelligence expert, but I sure know there are a lot of people in this town that know China well. In terms of the intelligence assets we have on the ground, if I knew what they were, I couldn't tell you that. But I think we've got a fairly good picture of what's happening in China.
This isn't a mystery like Gorbachev in Russia, where we had really difficult intelligence.
The problem that we have with intelligence is we're very, very good about assessing capabilities, what they've got, how many tanks they've got, how many planes they've got, how many soldiers they have. The hard part for the intelligence experts is determining intentions. What are they going to do with all of those capabilities? I think that's a conundrum that's been going on for years and years. One can only hope that when it comes to China, we can find some manner in which we can come to some sort of, I hate to keep using these words coming out of the Cold War, but some sort of perestroika or some sort of détente, because it's clear that China has I work in the Middle East. You can't swing a dead cat without hitting a Chinese businessman on a daily basis.
May we quote you on that?
You may. They're out there. They're pushing hard. They're pushing hard economically, as we saw with the agreement between the Saudis and the Iranians. They want to play heavily in a diplomatic field. We just got to make sure in the military that we can contain their military aspirations.
You've made a series of personal assessments about their intentions. What about Taiwan specifically?
What about
Taiwan specifically?
A tough policy issue. I think the Chinese, regardless of what we're seeing with all the noise in the air and on the sea, they're taking the long view. They believe that eventually Taiwan will return to the People's Republic of China. They're not in a hurry. I think militarily they know that trying to invade and occupy Taiwan would be an absolute disaster, but they've got time.
General, we appreciate your time this morning. Thank you, sir.
Thank you.
Fantastic. General Mark Emmett there, the former Assistant Secretary of State for Political and Military Affairs. Tom, fantastic conversation.
It's a conversation that dovetails 3 or 4 dynamics. What's so important here for particularly younger people forward, there's no static analysis here. It's dynamic analysis of politics, military, and economics. Just can't look at it with simplistic phrases.
We've got to push forward now to the CPI report, the inflation data coming out a little bit later this morning, about 34 minutes away. Going into that, equity futures are positive by 0.2% on the S&P 500. Yields a little bit higher by a couple of basis points. Your 10-year, 344.68.
Let me talk about Starbucks for a moment. You've been on the board for how long?
Wow, a long time, since 2006.
Okay, and when you got on the board, did you have to go to Starbucks every day and
I go to Starbucks a lot.
And
yes.
when you check in, do you have to wait in line like everybody else?
Yes, I wait in line like everyone else. That's an important part of the process, to see how everything's working, how long it takes, what's happening in the store. I take pictures of the cases. I do all sorts of things when I go in now.
So what's your favorite drink, can you say? Is that a state secret?
I make a joke about this. So I like my coffee black like me.
Okay. Now, Howard Schultz has been a mentor to you a bit. Is that correct? He's the founder of Starbucks.
Sure, for sure. Very important.
So what did he do that made Starbucks so successful? There are other coffee chains around the world, and it wasn't like he invented coffee chains. What did he actually do that made it the biggest in the world?
He really started off from the very beginning saying that he wanted to create a different kind of company, and that he had this point of view about leading through the lens of humanity. It sounds like it could be a cliche, but it's not at all. It is very much in the DNA of the company, how we look at things, how we do things. It's always through this point of view of people. And so at the end of the day, I think he put people first, not only in terms of the partners of the company, but also in terms of the customer. And at the end of the day, that is what has made the company so great.
Studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Look at the disconnect between equity markets and bond markets, both telling you extremely different things, and I think it's a little puzzling out there.
For the Fed, the more near-term pressing issue is that you'll still have 3 months or so at least of pretty consistently strong inflation prints.
The Fed's going to ease only if something breaks.
I think the market is very much already pricing in a soft landing.
The market is clearly not pricing in a recession, but neither is it pricing in a soft landing, and it's pricing in a wait and see what happens.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. The spring meetings of the IMF and World Bank from Washington today. And all I can say is right now, no one cares about the IMF meetings or the World Bank gatherings as well. John, in 29 minutes, it's about one thing and one thing only: inflation in America.
Can we put the no one cares in our promo for our coverage through the week? That'll work.
Actually, that would be great for Bramo's newsletter.
Nobody cares. That's rude, Tom. That is rude.
Lovely.
That is rude, Bramo. I'm not on board. Equity futures right now on the S&P 500 just about positive, as Tom pointed out, about 29 minutes from now, the CPI report in America. Look at payrolls on Friday, green light to hike on May 3rd for the Federal Reserve. CPI a little bit later this morning, likely expected to be a green light to hike for the Federal Reserve. As you guys at home know, though, this is more than just about CPI and payrolls. It's about the banking stress of the last month or so. And that might be a reason to pause, to have a bit more patience. And I would suggest that that was the argument that the Chicago Fed president made yesterday, Tom, in his speech.
Austin Goolsbee with a real splash. I'm going to call it a maiden speech, and that it was really picked up by the media. I saw one place called him the Democratic president from, the service with the Obama administration. Forgetting about Goolsbee and the politics of it, what I would suggest is this is an inflation report of a massively data-dependent Fed. I think we can't say enough of the urgency for them to glean data of these many narratives discussed here in Washington.
The reason I enjoyed that speech from Goolsbee yesterday certainly wasn't because of the politics, certainly not that. And it wasn't just because of the conclusion. It wasn't that either. It was just very well thought out in a very, very simple fashion. And ultimately emphasized that he doesn't think the policy is in conflict for very, very obvious reasons. If you look at the banking stress that we've seen over the last month, you can acknowledge that may well be a substitute for what we're trying to achieve on the monetary policy side. No real evidence that those two things are in conflict. In fact, some people might suggest this is evidence of a feature and not a bug for the Federal Reserve effort. They want financial conditions to tighten, certainly not in a dirty way like the way we've seen in the last month, but ultimately, this is the direction they're trying to push things through.
And Lisa, this is the strength of the Federal Reserve System. Loretta Mester of Cleveland, Barnard, first-rate mathematics, very sequential, very concision in her mathematics, and Goolsbee taking a much more holistic Chicago, and again, not the Chicago of Randall Krosner, the Chicago of Gary Becker, a more social view of what the Fed can do. This is every speech is different.
We don't know what data we're looking at, number one. We don't know where we're heading in terms of the inflationary environment, let's say post-pandemic. And they're basically reflecting those unknowns. I'm wondering if you wonder about banking stress, is that truly disinflationary? We don't know that either, because on certain margins, it could be stagflationary. So how do you put these pieces together to understand at a time when still inflation is too hot? And today's core number, which we're going to get in about 36 minutes, could show that it's actually accelerating when it looks to stripping out food and energy.
So
year over year.
Correct.
Yeah, let's do the data right now, 4.05% of the 2-year. That's what I'm going to watch here at 8:30, the dynamic of the 2-year.
Just last week, Tom, we were in the 360s. The 360s on a 2-year, now we're north of 4% again. And this is what I think a lot of people are grappling with, wrestling with at the moment. Where's the signal? Where's the noise? Is the signal or the noise in the data misses, a string of them through the whole of last week, or is the signal the noise, the payrolls report, which came in pretty robust and resilient? And we'll be asking the same question when we get CPI again in about 26 minutes' time. What is more important here? What we learned on Friday, together with what we will learn this morning, or the bank lending data, the look at that we've had so far, which is not a great deal of depth, but ultimately it's all we've got, which suggests you are seeing some tightening.
The confusion for our listeners and viewers is Holland Horst Clark at Citigroup looking for 1 or 2 rate increases with a substantial nominal GDP. And an hour and a half later, Michael Darda of Roth MKM going completely the other way, looking for, Lisa, diminished real GDP, diminished inflation, and a real squeezing of that animal spirit of America.
I don't get the sense that the daylight between both polls of
Jim Bianco has said that.
I don't think that they're getting closer together. So what's going to be the determining feature where we know
what's the determining
where we're
feature
at?
Before we get to Victoria?
It's what it always is, time and data. Time's the obvious one, and data's going to resolve this. Now, in early May, when the Federal Reserve meets, if you get the senior loan officer opinion survey, and it doesn't show a dramatic tightening in standards relative to what we got last time around, I think a lot of people might sit here and say, coast is clear. I would say you've got to wait for the one after that this one isn't sufficient. It will take time, and maybe it will take getting through the whole of this summer to find out what happens here. Now, if you ask a lot of economists at the moment, what is the longer variable lags for banking shock? I think a lot of people would say it expected to happen pretty quickly. So let's see what the data looks like, which again is why you get people like Goolsbee saying, patience, wait, let's see what this looks like. And I do think the Fed has the benefit of patience. If you've got a year-end dot of 5.1% and you're only one interest rate hike away from that, that's pretty good news, isn't it? To be fair, you're pretty close to what you think terminal is. You have the luxury of time on your side in a way that they didn't 6 months ago. The bigger problem for me, Tom, for the Federal Reserve would have been if this banking issue had happened 6 months ago with inflation much more elevated and we were still debating 50, 75 basis point hikes and they were signaling they're still some way away from the terminal rate. This is a different environment now. They've done a lot of work. They moved really quickly and now they get the luxury compared to the lack thereof a year ago of having a bit of patience and time on their side.
With General Kimmett here moments ago, I'll use a military phrase, expect the unexpected, which is maybe what we're going to see here in 23 minutes. On the equity markets and dovetailing all this narrative blather, Victoria Fernandez joins us, Chief Market Strategist, Head of Blather Study at Crossmark Global Investments. Victoria, I've heard this from so many people contacting us, emails, the newsletter, everything. Heads are spinning over the many narratives. How do you invest in equities in a measured way 3 years out, given the cacophony of narratives in 2023?
Well, look, Tom, I think when you're looking at a portfolio and you're looking at the data, because we're data dependent too, right? It's not just the Fed. And I know your conversations earlier were about the bias in choosing the data that fits your own narrative. But if we take a larger look at that and look at the whole picture, you're still in a time period, like I had said maybe 6 weeks ago or so, of confusion. You have bears, you have bulls, they're both adamant. You have a Federal Reserve that says we're not done hiking. We have more work to do. I think they're going to go ahead and hike at the May meeting as well, and then take their pause. And I think you have recession coming later this year. So with that outlook, we say to our clients, okay, where do we want to invest? Where do we want to put money? We don't want to be uninvested. We don't want to take money out of the market. We want to be a little bit more defensive. So we look at areas like healthcare, and I know it's been overbought recently, but if we're looking 3 years out, we still think there's some positive names you can have there, especially in the HMO space. You look at some of the biotech names. If you want to add a little bit more cyclicality, we like credit cards. I think you have to have that balance coming. And I know tech, everyone has been piling into tech. It's overbought at this point. I think there are what our CIO, Bob Dahl, likes to call profitable tech, a little bit more defensive than the high flyers. You can go in there as well and look at some names like a Cisco or a Qualcomm. So there's areas to invest, but I think you do need to take a step back and be a little more defensive with the outlook that we have.
Data dependent. We've been talking about how that means something different to everybody in terms of which data points they look at. What data matters most to you?
So, Lisa, it's funny because I think any data point that you give me, I can probably make either a bull case or a bear case out of that data point, right? Whatever my bias is. When obviously CPI in 20 minutes or so is coming out, everyone has been looking at that services number, the core services, the super core, taking out the rent component, what the Fed's looking at. I actually think this month we need to be looking at the goods component. The goods is where we've had all this disinflationary pressure as of late. It's why we've seen these numbers come down, the headline numbers come down. But let's look over the last month. Apparel's gone up, furniture's gone up, used vehicles has gone up. I would be very concerned if all of a sudden we're seeing goods numbers, goods inflation move higher when that's been the catalyst for disinflation over time. So I think look at some of those underlying numbers, continue to watch the labor market, not necessarily the headline number. In my opinion, it's the JOLTS number you want to watch. We can make a labor market that, starts to have a few cracks in there by taking some jobs off the table, by having the participation rate move higher without necessarily having layoffs. So watch the JOLTS number, watch the goods component of CPI. I think those are going to be your drivers as of late.
That's the soft landing hope, that's for sure. Victoria Fernandez across Mark Global Investments. Lisa, not so long ago, it was job openings. That was a target, an objective. We wanted that to come lower. We didn't want unemployment to shift higher. We kind of got that last week.
We did.
Didn't we?
We got exactly that, and that should have been really positive, and people shrugged it off, and it was a non-event after it happened. So at what point does data get dismissed if it just doesn't really change the narrative all that much? And I think that that's what we keep seeing. Is today going to be a snooze fest if it comes in bang in line with projections?
The market strategist from Texas dovetails with the economist from Toronto, David Rosenberg. And Rosenberg is heated that goods is being underweighted right now, and the goods inflation is massively disinflationary. And if you get to a true deflationary trend in goods, which is where we were pre-COVID, do we need to overweight this analysis of service sector inflation? I'm not sure at 8:30 we do that, John.
It's always highly dependent on the seat that you're sat in. Now, if you are in the bond market, a market participant, I would take the words of Connor Sen of Bloomberg Opinion, who said in the last week, the economy is guilty until proven innocent. If you're a policymaker at the Federal Reserve, or for that matter, if you're Secretary Yellen, you believe the economy is innocent until proven guilty. And the accusation, of course, is recession. And that's the conversation we'll keep having. I think that's the disconnect as well between what the market is pricing and what the Fed's projecting. The Fed can't sit here and say recession foretold. I think people in the bond market are willing to do that. Some people are. And that's captured by pricing at the moment with the 10-year at 3.44 and a 2-year just north of 4% after being north of 5%. Not so long ago. Equity futures positive 0.1%, 18 minutes away from inflation data in America. And I've got one eye, a sighting of Mike McKee.
Keeping you
up to date with news from around the world. With the first word, I'm Lisa Mateo. In Belfast today, President Biden met with British Prime Minister Rishi Sunak. Before the meeting, the White House said it didn't anticipate the two would discuss British calls for a resumption of trade talks. Instead, they were expected to talk about peace and investment in Northern Ireland and efforts to support Ukraine. The Biden administration is proposing a tough crackdown on auto pollution. Tailpipe emissions limits will be so strict it will compel automakers to ensure 2 out of every 3 cars sold in 2032 are electric models. Still, there are questions whether car companies can fulfill the limits on carbon dioxide and smog-forming pollution. Donald Trump wants a 4-week delay in the start of a civil trial over his alleged rape of author Jean Carroll. Now, his lawyer says a cooling-off period is necessary following his indictment in the case of hush money payments. The trial in the Carroll case is due to start April 25th. And Elon Musk says that most of the advertisers who fled Twitter after he bought the company have returned. Musk spoke in a Twitter Spaces interview with the BBC that attracted more than 3 million listeners. He also defended firing thousands of workers, and Musk turned the tables on his interviewer, questioning the BBC over hate speech and COVID disinformation. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Wall Street prepares for the latest read on inflation.
The inflation report is going to be very important.
Inflation is slowing, but the Fed has more work to do.
We have this huge disconnect between where the dots are and where the market is.
The Fed's saying one more hike. The market says 100 basis points of cuts.
Instant reaction on Bloomberg Surveillance.
Can you establish disinflationary vectors in goods and services?
And what it means for the Fed.
They're moving data point by data point.
Is this basically just whack-a-mole?
Inflation in focus today on Bloomberg.
I think the last hike was also an error on the part of the Fed. And data dependency is fine as long as you're not dependent on the wrong data. But if you're looking in the rearview mirror, then you're going to be igniting boom and bust cycles. And I'm afraid we're moving into the bust part of the cycle.
This really has been a feature of the conversation this morning on Bloomberg Surveillance. That was Mike Dowd, the chief economist and market strategist at Roth MKM Partners. This line right here, it's fine to be data dependent as long as you're not dependent on the wrong data. And Lisa, that's the conversation we've had so far this morning.
And what do you know what the right data or the wrong data is? What's the forward-looking data? What's the backward-looking data? These are the bulls in the equity market saying, if you look at the strength in the economy, you're not seeing the recession, so stop it already. And in the bond market, they're saying you're just not seeing it yet, but it's going to come.
Inflation, 13 minutes away. The bond market being proactive about all of this, discounting this idea that things are going to be, all right, okay, fantastic.
I relate to the bond market.
I'm sure you do. Equities right now, going into the CPI report, look like this. Equity futures positive by not even 1/10%. Yields a little bit higher through this morning. The 10-year Tom 344, higher there by about a basis point. The 2-year up by a couple of basis points to 4.05%.
The 10-year there, I'll look at the 2-year here in about 12 minutes. Right now, before we get to Michael McKee, Gregory Vellier joins us, Chief U.S. Policy Strategist at AGF. Greg, it's been a very cold spring on the East Coast. The Washington weather has been lovely. It makes us look forward to summer. Let's go to the debt ceiling, the issue no one's talking about. What is the path of the debt ceiling debate from this beautiful April morning out into July and, dare I say, to the fall?
Well, good morning, Tom. To my shock, nobody's talked very much about it. We have to have our taxes in by next Tuesday, I think. So the tax receipts will make a big difference in terms of the timing. When do we hit the wall? Probably late June. We might go into July. We have to remember they're gone for the whole month of August. Kevin McCarthy has wound up in a feud with many of his Republican colleagues, and they don't have a deal yet.
Maya McGinnis, expert on fiscal entitlements, suggests there's trouble out there X number of years. Within the debt ceiling debate, is this a Congress, is this a Washington that can do a redux of Simpson Bowles? Are we going to have analysis this year about the entitlement crisis that could be out there 7, 8, 10 years?
No, that would take too much political courage, so I don't see that. They won't deal with Social Security and Medicare until the crisis is absolutely imminent, and we're not there yet. Very briefly, two big fights here. One is to maybe reduce some spending, put a cap on some spending. The other fight is the debt ceiling and a possible default. On this latter fight, there's no agreement among McCarthy's troops. Many of them would not vote for a debt ceiling increase under any circumstances.
There's a lot of nuance here, and there's a lot of detail, and neither of which plays well in stump speeches and in commercials. What does speak well is when people blast the Fed, and we have seen that consistently through election cycle after election cycle, and now we're seeing it from Ron DeSantis, who may be running, we're not sure. He's on a book tour currently. I'm curious what you make of that, if that basically increases the politicization of a Federal Reserve amid a CPI report that we're about to get, and a real deep angst about how to deal with that inflation.
Well, that's a really good point. And all of a sudden, DeSantis is down in one poll I saw this morning by 33 points. Trump is ahead by 33. So DeSantis needs to shake things up. So he's going to go after the Fed. I don't think that's going to really succeed for him. And I would say this about the Fed. If there's a wild card at the next Fed meeting, it's commercial real estate. It's the concern, I think, within the Fed that defaults are going to become a bigger and bigger story. That may tilt the scales to just one more move, and they may then say, we're done because of commercial real estate.
How do they justify that, though, Greg? If their mandate is full employment and reducing or getting some sort of price stability, how do they justify that they're going to pause raising rates in the face of a hot inflation read that we're expecting to get just shortly here by saying commercial real estate looks problematic?
Well, it's hard to justify, and they still have egg on their faces in San Francisco and with the Silicon Valley Bank. But I think that the fear of contagion stemming from the commercial real estate drop. I mean, you walk around Washington, D.C., guys, there's no one in the streets. There's no one in the offices. So I think that the Fed has to acknowledge that if they stay really tight, you're going to get contagion.
I've always found like that about Washington. Do you ever see people in the streets here in D.C.? Isn't that always the way in D.C.? Whenever I'm here.
I was sitting in a car yesterday, and we didn't bring the Bentley down, but I was in a car, and the bottom line is the traffic's 1/3 what I've seen before.
I never see anyone in the city.
It depends where you go. There are actual neighborhoods, and then there are like the office building, canyons that were,
All right. Greg, thank you. Greg Valier of AGF Investments there. Inflation data about 8 minutes away, so Mike McKee's gone on tour. He's come down to Washington with us this time to break the inflation news. Morning, Mike.
Good morning. You break it, we fix it, yeah.
We're looking for something sticky, something hot in 8 minutes?
That's a good question, and there are a lot of people who think we will see some stickiness to it. We expect that gasoline prices went up, and that'll push up headline numbers. Used cars have been in an unusual situation, and at the wholesale level, they've gone up. It hasn't fed through yet, but at some point, we're going to see housing start to drop because rents have dropped. So nobody's quite sure what we're going to get here. The feeling is we get a slight drop in headline overall, and we get a basically unchanged core.
What's food doing?
Food has been, at this point, rising at a fairly steady pace, about 0.4% per month.
What are berries doing?
Tom.
On radio, it is McKee knows this. Washington has the best food.
They have berries.
John, they have fresh berries.
We're
going to do this on air.
John is moving here.
Seriously.
Fresh fruits and vegetables were up 0.2%.
Oh, you've actually got the numbers.
I've got that right in front of me.
Well, can I ask a question? We were talking about before while Tom enjoys his berries on air. I'm curious about this disinflation that we saw in goods and now a reinflation of that disinflationary force. You talked about used cars. Used cars prices increased in the month of March, according to the latest Manheim indexes. We've also heard that furniture prices are increasing, et cetera, et cetera. How problematic is that with the sort of rolling recessions now rolling the other way?
Well, it could be a problem if that all holds. Now, we've gotten some data from both Barclays and Bank of America on their credit card spends in the recent month, and both have reported goods spending down significantly. So that'll take some price pressure off. It's the services that the Fed is still looking at. And, of course, today we'll have our fancy graph of the J. Powell indicator, core services ex housing.
Are you seeing a little bit of division on the FOMC? Just starting to emerge, just a few voices looking for patience here.
I think that a lot of people have been looking for patience, but no, they all say we'll go one more and then we'll look around. There are some who said, well, we'll go one more and then we'll see if we need to go more. But remember the dot plot. The median dot was at 5.1%, but there were 7 above that, including 1 at almost 6%. So it's not like this is anything new. They're going to be data dependent.
Are we just finding out who those dots might be?
Yeah.
Who those people are?
Essentially, that's what's happening.
Do you know who the dots are?
No. I mean, some people will tell you, and some people won't. I mean, we have a pretty good idea.
I'm laughing.
Jim Bullard's at the top.
I'm just imagining, who are the dots? Who are the men behind the dots?
Don't get me going.
A Bloomberg surveillance special.
How different is Goolsbee from Charles Evans? Austin Goolsbee, Chicago versus the previous Carnegie Mellon Charles Evans.
Well, they're both very talented and experienced economists, so that stays the same. Goolsbee seems to be a little bit more dovish at the moment. Charlie Evans moved around with where he thought the data was. Sometimes he was hawkish, sometimes he was more dovish. The question now is, what does Goolsbee do when situations change? If we get to 5.1%, if the economy starts to slow down, and if we see any need for the Fed to start cutting rates, then how quickly does he jump on board? But again, we're all talking about 25 basis point moves in very small increments, so hawk and dumb is kind of a...
Yeah, gone are the days of 50 and 75 and talking up the potential for 6. That was only a month ago.
I know.
It's changed so quickly. Inflation data about 5 minutes away. Mike McKee's going to break that down with us in just a moment. CPI just around the corner. Jay Bryson of Wells Fargo is going to join us to break this one down. Going into it, equity futures just about positive. Yields a little bit higher.
typically between the time you start and they get out in the farmers' fields is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The inflation report in the United States of America, seconds away, 20 seconds away to be precise, going into it. Equity futures look like this on the S&P 500. Just about positive by 1/10%, a little lift after closing unchanged in yesterday's session. The Nasdaq a bit softer over the last 24 hours. Going into this report, we're up by a basis point on a 10-year, 343.40 on a 10-year right now. The inflation data in America just dropping. Mike McKee has more. Hey, Mike.
Well, it looks like we're starting off on a reasonably good note, or at least one that parallels what economists were anticipating. The headline CPI comes in up just a 1/10. That's down from 4/10 and also lower than the 2/10 that was anticipated. Puts the year-over-year number at 5%, down from 6%. So a significant drop in headline CPI. The core comes in at 4/10 increase, which is what was anticipated. That's down from a 5/10, and we're seeing a core rate on a year-over-year basis at 5.6%. That's up from 5.5% in February. So basically what we're seeing here is what economists anticipated, and whether it's going to give you any kind of significant indication about where we're going is kind of up in the air. You can make anything out of this that you want, because the headline number probably influenced by energy. I'm just looking now, energy down 3.5%. Gasoline prices down 4.6%. Now, we've known they've gone up since then. And here's an interesting one. Natural gas prices, and I guess this is not a surprise given that winter is essentially over. Natural gas prices down 7.1%, the utility natural gas that you would pay. Food prices flat. Tom had asked before the break, what's food doing? And it had been going up consistently, but not now. It has fallen back some. And rents, they have not made progress, it looks like. Shelter costs up 6/10. That's down a little bit from the 8/10 the months before. And rent of primary residence and OER up 0.5%. So we're still seeing the housing impact on the overall numbers, John.
So we've talked about the inflation report relative to what economists expected. I think the market's telling you what the market was looking for going into this one. Look at this move in the bond market. Yields lower by 9 basis points on a 2-year, taking back some of that post-payrolls pop at the front end of the curve. We're back to about 390 on a 2-year. On a 10-year, yields down by 5 basis points. Just sub 340 on a 10-year yield in America. Off the back of that, some enthusiasm in the equity markets, equity futures, a bit of a pop here by 0.75% on the S&P 500 after being virtually unchanged going into the print. In line for core inflation, down from the month before. Headline inflation, a whole lot softer than the previous month, and a little bit of a downside surprise relative to expectations. So equities higher off the back of this, Tom, by 0.75% on the S&P, and a rally in the bond market. The initial knee-jerk reaction to this one, yields lower.
I'm going to pick, there's 8 ways to go here, John. I'm going to pick the equity market here. Dow futures above 34,000. John, can you imagine if we get to Standard & Poor's future level of 4,200? We're not quite there. That's what everybody's following. But at some point, given this economic data, you're going to get a stock market cover of the shorts, the gloom, the caution that's out there. Where is that throw in the towel mood given this kind of economic data? It's out there somewhere. I don't know.
I'll paraphrase Michael Harner of Bank of America, who said recently that we're too optimistic about rate cuts and not pessimistic enough about the reasons for those rate cuts. And I think that's a really, really important call. Tom, there's a difference between getting that disinflation the Fed is looking for without significant economic pain. There is a worry that the banking developments of the last month will lead to significant economic pain. And I don't think we've cleared that hurdle just yet.
This is precisely the point where Darda mentioned this, Michael Darda mentioned this yesterday. Do you get a disinflation with okay GDP, or does GDP really come in? And that's the raging debate given disinflation.
If you're on the FOMC after this one, Lisa, and you looked at this print and you were already sitting there pleading for patience, did you get a little bit more information, some data on your side that would take away some of that urgency to do more?
No, I didn't. And that's what I find surprising. And I'm looking at this market and not understanding what they're looking at. And I want Michael McKee to weigh in on this. Did you see any progress whatsoever other than the fact that you basically had transitory types of food and energy prices make a move in the positive direction?
It's the core that went down. The food and energy prices went down significantly, especially natural gas. Gasoline prices were surprisingly down as much as they are, because we all know they've gone back up in recent weeks. Used cars and trucks down 11.2%. So whatever is happening between the wholesale numbers and the retail numbers, we are not seeing any kind of action. New cars, however, were up 6.1%. There's still a shortage there, which some say the automakers are encouraging because it keeps the prices higher.
So John just asked me, if I were on the FOMC and I got this data, would I feel comforted? If I otherwise was moved toward this sort of pause or more cautious approach, would this give me some sense of confidence in that approach? Do you think that it would?
I think it would reinforce the idea that you're on the right track, and that what you need to do is leave rates high enough so that the cumulated effect of all your rate increases starts to have a greater impact. But what they're really going to want to see, and they won't have by May, is evidence of what's happening in the housing market. We've been anticipating, but because of the lags in rents falling and getting into CPI, most economists have said we won't see it until like the May numbers, which we'll get in June. At that point, we might see a big drop, and that's another reason why the Fed may want to, express caution coming out of the next meeting. I'm not sure they'll say we're done, but they will dial back the idea that a rate increase is automatic at the next meeting.
Quite a move in the equity market, a pop on the S&P 500 of almost 1 full percentage point. Yields lower now at the front end by 14 basis points. I think we often stress in the minutes after any big data point, payrolls or CPI, sometimes these moves don't stick, but this is quite a significant move at the front end. We're down about 14, back into the 380s on a 2-year. The 380s is where we were trading Friday morning, Tom, going into the payrolls print. So we've taken back some of that post-payrolls prop. I don't think this changes the consensus view at the moment. Consensus seems to be the Fed goes again on May 3rd. But certainly, if you were of the opinion that the Fed should be more patient, maybe that provides you with some more evidence to be so.
I don't have the technicals in front of me, but John, I agree the 380 level is critical for, and I'm talking in a broad sense of 10 ticks, and the 2-year yield to see a 379. We're not there yet. That would be a big deal. To parse this, as Michael McKee dives into the data, is Jay Bryson, chief economist at Wells Fargo. Dr. Bryson, thank you so much for joining today. One set of data does not make a trend. If we put together 3 months like this, what does it signal to Jerome Powell?
Well, so, I mean, if you look at the last 3 months, right, that core rate was up 0.4%. And so if you look at the last 3 months, you're still running at an annualized rate of close to 5%. There. Now, the good news is that the rent component, or the owner's equivalent rent component, is starting to come in. And so that should continue to put some downward pressure on inflation as we go forward. But we're still a long way from 2% at this point. And so, if you're Jerome Powell, you look at this and you say, I think Mike just said it, we're on the right track, but I don't think this makes the case for a pause in May. This and what we saw earlier in terms of the jobs report, I still think, knowing what I know right now, that they go 25 in May.
A lot of people agree with you, and yet they seem to be increasingly pricing out the potential for further rate hikes and possibly a great rate cutting cycle to start in the second half of this year. Jay, what would we have to see on Friday to discount the strength, the underlying strength and core that we see in this report, albeit perhaps not more than expected?
So when you say Friday, Lisa, are you talking about the retail sales numbers we're going to get out on Friday?
JP Morgan's earnings. JP Morgan earnings, bank earnings, and how much that lending stress.
Yeah, so right, if we're starting to see signs, and in the upcoming bank earnings, that there's a lot of stress out there in the financial system, with banks in terms of their earnings, in terms of the credit standards, tightening things of that nature, that potentially could start to swing things in the direction of a pause in May. I mean, we'll see. What they say, what the banks say in the coming weeks here. But, I think at this point, that would be the thing that for me, would say, okay, maybe they actually go and pause, is what sort of stress we're seeing in the banking system.
Jay, there seems to be a complacency in markets about the fact that the Fed will be able to get inflation under control, that the rates will go back down to 3 or perhaps even 2% in the next couple of years. And I'm talking about 10-year yields. Are you less confident about that based on the increasing pressure for them to pause or just take a step back as they wait to understand what the dynamic is?
So in terms of the longer end of the curve, Lisa, I could see that going back to 3%. I mean, I just think that given the structural challenges in the U.S. economy today in terms of its long-run growth potential, for me, a long-run 3% 10-year yield makes perfect sense. I guess where I have a little bit more question is in terms of the 2-year yield. I don't agree with the view that the Fed's going to be cutting rates by the end of the year. I mean, potentially, right? If we're in a recession at the end of the year, I could definitely see that. But if we have, a soft landing in the economy, I could see the inflation rate here getting stuck at 3 to 3.5%. What does the Fed do at that point? Does it throw in the towel? And does it say, okay, we can live with 3 and 3.5%? Or do they really mean it? We need to get back down to 2%. And if they need to get back down to 2%, then you're not going to see, I think, rate cuts at the end of this year. I think you're going to see rates remain at a minimum elevated at that point. And so I have a little bit of a disagreement where the 2-year is right now.
Hey, Jay, you're not the only one. Jay Bryson of Wells Fargo, thank you, sir, on the latest inflation data in America, which spurs a big move at the front end of the yield curve. Yields lower by 11 basis points now. You can round it down to 12 if you wish. About 390 on a 2-year at the moment. Equity markets with a real lift, still positive by 0.8%. The latest data, 0.1% month over month on headline inflation. We were looking in our survey for a median estimate of 0.2%, so that's a little bit lower than expected and much, much lower than the previous month-over-month move. If you look at core, strip out food and energy, that comes in at 0.4, in line with expectations, and a very, very slight improvement on the previous month-over-month read of 0.5%. Seemingly, Tom, the takeaway from this one, this breeds a little bit more life into going again in May. Right. It doesn't provide more reason to do much beyond that. And I think that's the story that you see emerging at the front end of the curve.
Quickly here, the McKee cam shows a McKee that really needs to weigh in here. What do you got?
Well, I've got everybody's favorite number, the J. Powell index, which is core services X housing. And it's a major improvement from 0.43 increase in February to 0.29. So we're down quite a bit there. Headline. And the BLS does say in their release that it was housing and rents that really pushed up the CPI, offsetting the energy price drop because housing is such a big component in the CPI.
Equity markets picking up at 0.8% on the S&P 500. In the next hour on Bloomberg TV, Priya Misra of TD Securities, Colin Martin of Charles Schwab, David Kelly of JP Morgan. All of that coming up in the 9 o'clock hour on Bloomberg TV.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. China indicated it will maintain pressure on Taiwan following its large-scale military drills. The maneuvers began after Taiwan's President Tsai Ing-wen met last week with U.S. House Speaker Kevin McCarthy in California. A Chinese spokesman said, quote, "We will not leave any room for any form of Taiwan separatist activities." Ron DeSantis travels to Ohio and New Hampshire later this week after stumbles left him further behind Donald Trump in the race for the Republican presidential nomination. The Florida governor is expected to formally enter the race after the state legislature wraps up in May. In the Real Clear Politics average of polls, DeSantis trails the former president by 26 points. Emerson Electric has agreed to buy National Instruments in an all-cash deal valued at $8.2 billion. The price represents a 49% premium to National Instruments' closing price on January 12th. That was a day before the maker of measurement systems announced a strategic review. Mortgage rates in the U.S. have dropped for the 5th straight week to their lowest level in 2 months. According to the Mortgage Bankers Association, the contract rate for a 30-year fixed loan falls 10 basis points to 6.3%. Meanwhile, the group's index of mortgage applications rose 7.8%. And American Airlines says that first quarter profit will likely fall short of Wall Street's estimates. Persistently higher costs are countering some gains from travel demand. Meanwhile, there have been signs that consumers are opting for lower fares, and there's been a recent slowing in bookings. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
I was at the front line of the 2008 financial crisis. Every time we thought in 08, okay, we've done enough, it's over. Things flared back up again and they got worse. And so I'm not ready to declare all clear, but there are hopeful signs that these risks are now better understood and calm is being restored.
As we heard from Goolsbee of Chicago yesterday, Kashkari of Minneapolis there, Neil Kashkari, the Fed president for that important Fed, best in the nation on child care economics. They own the high ground on this coming out of the pandemic. What are we going to do about infant care in this nation? Right now, in a moment, we're going to get to Jeff Rosenberg, but we've got to mop up here the bond market dynamic, and Lisa Bramwitz does that better than anyone. Lisa, I'm looking at the 2-year. What do you look at?
Well, I'm looking right now at Fed funds expectations and basically slightly coming off some of the number of people who are expecting the Fed to raise rates at their May 3rd meeting, but still very much solidly priced in. It's the rate cuts after that get my attention, now pricing in about 100 basis points again of rate cuts by January. Was this report enough to justify some sort of sense that, yes, inflation is coming down, and that, yes, it's going to come down enough to necessitate rate cuts?
Some of the themes here in Washington. We welcome you on radio and television, the meetings of the IMF and World Bank, but far more now, inflation analysis and markets really moving on. This maybe not like 10 minutes ago, but certainly a lift to equities with lower yields. To synthesize, Jeffrey Rosenberg joins, portfolio manager of Systematic Multi-Strategy Fund at BlackRock. He's been medicated over the last 4 months, the beginning of 2023. It's been chaos. I'm fascinated, Jeff Rosenberg, with your wide mandate at BlackRock, how you've survived 2023. What have you done to your portfolio given the cacophony handed to you?
Well, it's a good framing for the question in front of today's data, Tom, because it is particularly a period of heightened uncertainty around the outlook. We talked about it in the earlier segments in terms of the uncertainty around inflation. We're moving through this period into a new period of, I think a pause and a reflection from the Fed, whether they hike in May or not. For our portfolios, that's made directional exposures, whether markets are going up or markets are going down, pretty challenging environment to try to pick that direction. We have the benefit of being able to do a lot more flexible things around our portfolio to take away the direction and really look underneath the hood and play the dispersion that we see in markets. And particularly, one of the big stories is, exceptionally high, historically high interest rate volatility relative to low equity volatility. But that low equity volatility is really a story of the surface. Underneath the surface, there's tremendous amounts of dispersion, and we're trying to take more advantage of that and lean our portfolio more into dispersion than in direction.
As you avoid trying to take a call on necessarily what's going to happen at a time where that seems to be pretty much impossible, Jeff, I'd love your read on what we just experienced, which is an almost in-line inflation report for CPI, the core CPI coming in line with expectations, and this market cheering and actually now expecting even greater rate cuts in the next 12 months. Does that make sense to you?
Well, I think Jonathan Ferro has said this in a couple of contexts, maybe more around payroll. Be careful about, the initial market reaction as to whether or not that's the longer run message. But the initial market reaction is really talking about, the beat on headline and the impact on food and energy prices. It helps, and it helps a lot in terms of the optics around inflation going down. I think that's the near-term market reaction. The stuff I'm focused on and we're focused on is really about the labor markets. It's about wage inflation. It's really about what we see in this report in terms of core services ex shelter. I think Mike mentioned that in the earlier segment. There's a little bit of a trend coming down there. I wouldn't read a huge amount into this report in terms of giving the all clear for that much more important and durable services inflation. I think it's a positive. It's in the sense that it wasn't a big negative surprise upward, and I think the market is trading a little bit off of that, but mostly off of the headline here this morning.
As we careen toward that May 3rd meeting of the Federal Reserve, what are you watching to get a sense of what is going on in real time beneath the hood with credit lending, with the expansion or contraction therein?
Yeah, I mean, obviously the big uncertainty, and Powell characterized it very well, in that the direction of the banking crisis in March is to contribute towards tighter financial conditions, to contribute to the transmission of tighter monetary policy. The direction is clear, the magnitude is not. And so everyone's focused on the weekly H8 report and what's going on with bank lending. The issue, though, is that bank lending expected standards tightening had been in place well before the banking crisis. So the issue isn't whether or not banks are tightening credit. The issue is how much did the banking crisis in March accelerate those trends. That is very hard to measure. It certainly has accelerated something we can measure, and that is deposits moving out of banks and into money market funds, waking up to it's no longer zero interest rates, and that's perhaps accelerated the funding costs of banks. But whether or not that transmits, whether that's a bank margin issue or whether it's a real economy issue, remains to be seen.
Jeff Rosenberg, in the equity space, we can talk about bull market, bear market, we can talk about movements up, ratios and such. In the bond market, we do less. Are we in the beginning of a bond bull market, which is generally price up and yield down? And if I use the 10-year as a proxy for that, do you frame out a surprisingly lower 10-year yield out 1 year or 2 years?
I think the jury is out on that kind of 1 year, 2 year framing of the question, Tom. Clearly, what's been happening over the last couple of weeks, really since and kicked off by the banking crisis. Remember, pre-banking crisis, we were debating, a 50 basis point hike and whether the Fed needed to do more.
Right.
We kind of forgot all about that. A 50 basis point hike and whether the Fed needed to do more. We kind of forgot all about that because it's really much more a pivot towards, did this banking crisis accelerate tightening? I think the jury is out, but clearly the momentum in the bond market is towards more of a focus on recession risk. And as Lisa was talking about, the pricing in of, a very rapid turn towards Fed cuts. We think that's probably overstated, but that's where the market's at right now.
Well, I want to be junior portfolio manager today. If people are saying long duration does better, big tech and equities does better, is this the time for Jeff Rosenberg to do a Jeff Vinnick, George Vanderheiden redux from 30 years ago? And do you need to go out and buy a 20-year zero coupon bond to play a long duration play over a year or 2 years or 3 years?
The long duration call is really about recession versus inflation. And right now, as you can see after today's report, it appears that inflation fears are waning, and that's going to give some more credence towards the notion that duration can once again play the diversifier in a recession environment. You want to be, out as far in duration as you can stomach. We're a little bit more cautious on that view, however, Tom. And again, it was to my comments that, today the market is kind of playing off the headline. It's the services piece and the inflation from the wage picture and these still very tight labor markets. I think we still need to see that loosen up before you can say it's all clear and we're back to duration is unequivocally, a clear hedge to a recession risk. It certainly is if you get the recession, but it becomes much more vulnerable if inflation is more sticky than we're currently anticipating, than markets are currently
Jeff Rosenberg. Well, Jeff, thank you so much. Jeff Rosenberg, always with BlackRock. Lisa, I think this is just absolutely critical. And the way I would look at this is the visible, tangible bets on a short stock market that's out there. Nobody loves equities right now, which tells me nobody loves long-term duration fixed income as well.
I don't know how we can really understand what people love or don't love because they're buying protection against a downturn. They're renting the protection. They're not necessarily selling. And you're seeing that with respect to big tech, for example, where people have really bought quite a bit in the past couple of months. In terms of the bond market, I don't know how much signal, I don't know how much noise. The bond market's gotten noisier and noisier. That MOVE index with volatility surged to the highest levels in more than a decade just a couple of weeks ago, and you're just feeling that churn in trading positions.
The din in Washington is going to get noisier as well. In earnest, the meetings of the IMF and the World Bank, many narratives, including the fragmentation between America and China. Stay with us through this Washington Day. This is Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company, and even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Live from Washington, D.C. for our audience worldwide, I'm Jonathan Ferro. Good morning to you all. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from Washington, coming up, the latest inflation data, keeping a May hike in play. As division begins to emerge between Fed officials, equity markets picking up, going into bank earnings. We begin with the big issue, inflation in America.
It's about inflation and CPI data. CPI.
Very interesting. We are at this key point. We've seen inflation be a concern.
A push and pull battle.
Between the services side inflation, higher rents.
That's really going to set the tone.
We're still a long way from 2% at this point.
Look, the Fed wants to hike.
The market has priced out so many rate hikes.
We think there are too many cuts priced in.
The labor market is still tight.
It seems hard to see a scenario where they're pausing.
But it's really torn because it's got these obvious troubles in regional banks.
They will have to go 25.
The best thing we can hope for is a pause.
You have to be careful what you're wishing for.
I don't think this makes the case for a pause in May.
I'll touch base with Mike McKee in just a moment. I want to kick things off with TD's Priya Misra. And Priya, get your thoughts on what we saw about 31 minutes ago.
Sure. So I think inflation remains solid. Core inflation came in at 0.4. But I think the forward-looking indicators, what we were looking at was the details of the report. Shelter inflation came down, and we've been waiting. I think the Fed's been waiting for shelter inflation to respond to lower home prices as well as lower rents. So I think the market's looking at forward-looking indicators. Inflation has peaked. It's still high, but it's starting to moderate. And once shelter turns, it's a very large component of core CPI, headline CPI, PCE. It also tends to be a very trending component. So I think what we took comfort in was that the shelter component has started to turn lower. This implies some of the pressure on the Fed. Now, we do think that they're going to go another 25 in May, perhaps another 25 in June. But I think the pressure that had been building up on the Fed, with shelter inflation remaining high, ex-shelter CPI services remaining high, some of that pressure is easing away. And I think that's why the market's responding. The market's still sort of torn around that May hike, and I think they'll go. but it's really what happens after that. And we do think that the other issues, the banking credit crunch, as we're calling it, is going to compound the impact of rate hikes. The economy is going to head into a recession. The Fed's going to be cutting by the end of the year. But I think today's report, at least it tells you that a big component of inflation that had just propped up core services inflation for so long, that's starting to turn. Hard to say how quickly it's going to turn. First sign we've had, but it's the lowest shelter reading in a year. So I think that's at least comforting to risk assets, because at least it's telling you that that one constant source of pressure on inflation and the Fed is starting to ebb a little bit.
Priya, just to be clear then, you see reasons for the 2-year yield to drop by the 10 basis points it's dropping by this morning?
So the 10 basis points by itself seem like a lot. But I'll tell you, I think the market reaction to all data surprises is going to be asymmetric, meaning if we get weak economic growth data, weak bank earnings, or weak inflation, I think we react a lot more because, I think the market's looking at when is the Fed done? When does the cycle turn? The market's always forward-looking. So I do think that data surprises will have an outsized reaction when it's a little weak. So in that context, the 10 basis points doesn't seem that much. And here's another way to think about is that 10 a lot. The market was pricing in before the report 3% on Fed funds by the end of next year. If inflation is decelerating, if the economy is heading into a slowdown, I think 3% is highly optimistic. If the economy is slowing, we're in a recession next year, I think there's a case where the Fed's cutting a lot more than 3%. So that's why, I wouldn't push back. It seems like a big reaction for the fact that core inflation is still strong. But if inflation pressures are moderating, and I think we remain very concerned about the impact of the bank credit crunch on the economy, then 3% Fed funds is too high. So I think that 2-year rate has a long way to go before it prices in a true hard landing scenario.
Priya, it's funny you say that because it echoes something that Neil Dutta of Renmax said as well. Either we've priced in too many rate cuts or not enough. There's kind of no in between if we really face a banking issue. Is that the kind of idea that you're trying to get across as well?
Exactly. And I think the market prices in weighted average, distribution of outcomes. I think it's a very, what we're calling a bimodal distribution. There's the view of a soft landing. The Fed gets to 5.25, 5.5, wherever they end. And then very slowly over the next 2 years, they get to some neutral 2.5 or 3% rate. And then there's the scenario that we're in that camp, that the economy slows down substantially and the Fed starts to cut rates, but they cut a lot more. I don't see an in-between. I think these are the two scenarios. Every data point is changing the probability of these two scenarios. And today with a slight, at least the fact, now if today's report had been driven by some one-off category, I wouldn't have read much into it, but it was driven by shelter. And we've been waiting for shelter to start to respond to the fact that home prices are falling. So I'm taking this to be a sign that shelter's turning. And so if the inflation pressure is lower, growth starts to weaken, I think you're supposed to put greater odds on the scenario that the Fed is cutting perhaps later this year or early next year, maybe not very soon this year, but then cutting a lot more next year.
Priya Misra of TD alongside us. If you just joined the programme, welcome. About 35 minutes ago, inflation data out. Yields dropping off the back of it, down about 9 basis points on a 2-year to 393. Equity markets popping just a little bit, although we've retraced some of that move. We're still positive on the S&P by about 0.5%. Mike McKee breaking down the numbers. Mike, you've had about 2, 3, 4, 5 looks at this. What stands out for you now?
Well, Priya said that the market is forward-looking and wants to know what the Fed is going to do next. I think this keeps the Fed on the path to a 25 basis point move on May 3rd. But after that, it's still very cloudy out there because, as she noted, we saw a big drop in headline inflation, which was largely energy and food price driven. Energy prices falling significantly, especially gasoline and natural gas. But the core barely moved. And that's because the weight of housing is so great. Even though it ticked down by 1/10, it's still pushing up the overall indexes. And you can see the core rate went up during the month of February to 5.6% from 5.5. Now, why is that? It is shelter, and shelter is likely to be coming down. It's a question of how fast. Now, here's the CPI core services ex-housing. This is the number that Jay Powell is touting. Take housing out because of its weight, and you can see that we've got a significant decline going on both on an annual and a month-over-month basis in services inflation, which the Fed says is where we're really getting inflation these days. So what does it mean for the Fed? Well, a lot of Fed speak in recent days, and basically what you've got is a division but not a real disagreement. There are a group of people on one side saying, yes, definitely pause after May. Pat Harker and Neil Kashkari, two of the latest there, and also Austin Goolsbee in one of his debut speeches signing on to that. And then the other group says, well, let's pause, but we'll see what happens after the next meeting, and if we need to do more, because we are determined to get down to 2%. And I would point out, John, one last thing here. If you take a look at the dot plot, yes, the consensus was for a 5.1% terminal rate, effective terminal rate, which would put you at 5.25. But look at above that. There are 7 dots of people who think that they are going to have to go higher. So it's going to remain a live possibility, even with inflation coming down a little bit.
If you get the opportunity, and this is not for you, Mike, just for the audience, and you haven't done this before, go to the summary of economic projections that the Fed delivers every quarter and have a look at the range, not just the median. Have a look at the range. It's really quite wide going out the next couple of years. Mike, great reporting this morning. As always, Mike McKee's going to be with us down in Washington, D.C. through the week to cover some of these issues. Bank of America just put out a note looking ahead to retail sales. They say a March malaise. They say the following: the sequential slowdown in spending after the surge in January creates meaningful risk of negative GDP growth in 2Q. That's the latest from Mike Gapin and the team. I'm pleased to say we can continue this conversation. Jumping on the line for us, Colin Martin of the Schwab Center for Financial Research, fixed income strategist. Colin, the latest from the Federal Reserve. I want to start with this note here from Goolsbee of the Chicago Fed, who came out with a really interesting speech yesterday. Mike McKee called it a debut speech. He said, at moments like this of financial stress, the right monetary approach calls for prudence and patience for assessing the potential impact of financial stress on the real economy. Is that what you expect, Colin, this Fed to embrace?
You know, I think so. And what I liked about his speech, he was pretty open and clear about his views. And I liked how he even commented on the potential impact. He kind of quantified the impact of tighter bank standards and what it means. And I think what's interesting, if we look at that graphic that Mike put up before of the range of Fed speakers, none of those outcomes, at least in the near term, discuss a cut. And I think that's important when we look at the Fed versus the market expectations. I do think they'll hike in May. This morning's report, I don't think that'll change anyone's views. I guess it was a step in the right direction. But if you look at core CPI, that's still way too elevated. I know that's something that they pay a lot of attention to. But going forward, they wanted to continue to move lower. But before we get to the potential, discussion of cuts, we don't see too much out there. I mean, we're starting to see some cracks in the labor market, but just slightly. I mean, the report last week with non-farm payrolls, it was, yes, the smallest gain in a few years, but we're still seeing the unemployment rate at a multi-decade low. So I think we'll have to wait and see. I think when we're putting a lot of weight to Goolsbee's speech, where they should hike, but then see what plays out from there, understanding that there are long and variable lags, and we're still just a year into this.
Priya, we've talked about the 10-year with you repeatedly. I believe you've been long the 10-year since 4%. We're down to about 340 right now on the 10-year, 337, 338. Between 4 and 340, there's been a ton of volatility in between. Priya, are you sticking with that long on the 10-year?
I am. I mean, am I pounding the table that this is the time to put all your chips on the table on the long? No. We took some profits, but what happened between that 4 and 340 actually increased our conviction on the slowdown. I think we were in the slowdown camp. The catalyst that can make it into a deeper recession is the tightening in bank lending standards. And these are very non-linear effects. So I would agree with Sean, the point that the Fed, or with Goolsbee, the Fed, I think the threshold for them to pause is not that high because of all the uncertainties. We were already worried about monetary policy lags. Now we're looking at the banking system. Pause, but then do they cut? Can they be preemptive? I think inflation is going to not let them be preemptive. And so what the 10-year does is it allows you to position for the slowdown without being as particular on when does the Fed start to cut rates. It's much more longer term. I would say 5-year or 10-year is still attractive if you're not sure when inflation will allow the Fed to respond. I think when the Fed starts to respond, you should be in the 2-year. But I don't know if now is the time, because inflation, as we just noted, it's still high. Wages are still high. The labor market is strong. It'll turn. We just don't know when. So I would say being further out the curve, 5s or 10s, you're positioning for the slowdown that I think the bank deleveraging is going to make much worse than just monetary policy tightening would have.
Priya, the latest data we've seen so far, we had a string of misses last week, and this is a question that a lot of my audience, a lot of our viewers have reached out to us about. They want us to ask people like you, what do you put more weight on last week, the misses or the payroll story, or the lending data that came out later that afternoon on Friday?
I think that just tells you, keeps us all busy and somewhat sleep deprived. You have to look at all of this data. I do think what we look at is the more leading indicators, maybe a little bit more than payrolls or CPI, frankly. Unfortunately, the dual mandate of the Fed is the most lagging indicators out there. So I would pay attention to the lending data. I think that's telling us, future credit creation. And I was most concerned with the ISM services picture. If the consumer is slowing down, and is that because of rate hikes? Is that because of the savings buffer going down? All of that? I think that, to me, is the first sign. If consumer spending slows down, and we're going to get retail sales, we expect another weak report. I think that's going to make the market more nervous about the move from goods to services. If the service momentum is starting to slow down, that's going to feed through into the labor market at some point. It just could take some time. So, but I think the misses, to your point, it's slowing. The pace of decline, I think we need more data to see, are we slowing into a recession, or are we just slowing to trend growth? In our view, we're slowing into a recession, but I think that only time will tell.
Priya, Colin, stay close. We'll continue this conversation. Looking at the bond market right now, we give up some of the initial move off the back of that CPI report. We're still lower, though, at the front end by 9 or 10 basis points on a 2-year. We come back down to about 390-ish. That equity market lift is sticks, just not as pronounced as it once was. We're still positive by about 0.6%. Let's get you some movers going into the opening bell. Let's do that with Katie.
John, American Airlines under pressure this morning after the company said that first quarter profit will likely disappoint, expected between 1 to 5 cents a share for the period. That's according to a filing. Again, that's below the analyst estimate. Moving on, we do have some M&A movers. Brookfield is buying Triton Infrastructure for about $85 per share, stock up about 10%. National Instruments also on the move. Bloomberg reporting that Emerson Electric is nearing a deal for the company. That's according to people familiar with the matter, John.
Katie, thank you. Coming up on this program, counting you down to the opening bell, about 15 or 16 minutes away, Secretary Yellen shrugging off economic concerns.
The U.S. economy is obviously performing exceptionally well. I'm not anticipating a downturn in the economy, although, of course, that remains a risk.
That conversation up next.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food. It gives us jobs. It gives us, of course, oxygen. We're taking too many fish out. We're polluting it. We're making it warmer. And only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance. Our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
not really seen evidence at this stage suggesting a contraction in credit, although that is a possibility. The U.S. economy is obviously performing exceptionally well with continued solid job creation, inflation gradually moving down, robust consumer spending. So I'm not anticipating a downturn in the economy, although, of course, that remains a risk.
Treasury Secretary Janet Yellen playing down recent turmoil in the banking sector. The IMF sending a very different message.
Some of these pockets of vulnerabilities could spread. What we are seeing right now is the risk that banks are going to look at the outlook. They're going to look at their bottom line. They have to pay more for deposits. They're losing deposits. They're booking losses on the asset side, on the holdings of long-dated fixed income assets. And that could weigh down further on economic growth, both in the U.S. and in the rest of the world.
This coming as the biggest banks prepare to reveal how their deposits fared. We'll get numbers from them a little bit later this week. Analysts estimating a $521 billion year-over-year drop from JP Morgan, Wells Fargo, and Bank of America alone. That would make it the largest decline in a decade. For more, Bloomberg's Anne-Marie joins us right down here in D.C. AMH, can I just say a little bit of daylight between Secretary Yellen and the IMF?
Just a little. I think there's a lot, Jonathan. What you're seeing is the Treasury Secretary having a glass half full moment, while Kristalina Georgieva is really glass half empty, especially when it comes to the global economy. Secretary Yellen yesterday said we need to stop with this negativism. Why are we not being more positive? One of the key tensions, besides the banking industry and obviously the rest of the world feeling what the Fed is doing, which is an aggressive rate hiking and how that impacts banks' bottom line, not just the United States, but around the world, but globally, this idea of a fragmented economy. Kristalina Georgieva talked about the geopolitics of this and how fragmented economies and this pressure on the geopolitical world can mean lower growth. And what she's really talking about there is this U.S. policy of friendshoring, of nearshoring, specifically when it comes to China. And Secretary Yellen yesterday came out and she said that point has no validity. So you're going to see a lot of this back and forth as we have the IMF meetings continuing this week.
AMH, the Treasury Secretary, sounding more and more like a politician down in Washington. Priya Misra, Colin Martin back with us. Colin, was that the politician, Secretary Yellen, or the economist when she said she's seen no evidence of contracting lending?
I'd say that was the politician, because the evidence of contracting lending is pretty clear if you look at any of the data from the Federal Reserve. So when we look at that debate, we side more with the IMF, where there are plenty of cracks forming. And this is a question you posed right before the break. We are seeing this, whether it's the ISM manufacturing, ISM services. We saw it yesterday with the NFIB small business optimism in terms of plans to hire. So we think there are a lot of cracks forming under the surface, but it really does all come down to bank lending. And I think that's very important right now. I'm sure most of your guests are talking about this. But if we go back to that senior loan officer survey that we got a few months ago, that was from the fourth quarter of 2022. And we were already seeing signs of stress in terms of tighter lending standards, reduced demand, higher rates, things like that. Now, because of the bank failures and the bank situation, I think that's only likely to get worse. Now, just because we're not expecting more failures or we think this is going to be a full-blown banking crisis doesn't mean that there aren't negative consequences. If the Fed is reducing its lending, that's just taking money out of the system. So we do see that as a risk going forward. It doesn't mean that we're seeing a recession in the next month or next quarter, but we would expect over time to see that impact result in slower growth.
This phrase data dependency, I think a theme for us this week, over the last month, has been dependent on what data. And if we put more weight on maybe the less traditional indicators like the bank lending data than, say, CPI and payrolls. This is what Priya and I were talking about moments ago. Priya, this is what I got from Stuart Kaiser over at Citi. This is his view on the situation following the inflation print from an hour ago. The CPI is not as positive as the equity market move. Investors have not yet been jarred from the view that inflation is on a sustainable downward trend despite recent data, but we expect the Fed to cajole markets into more hawkish pricing. Now, Priya, based on what you've told me so far, I imagine you're pushing back a little bit against that view.
Yes, because I think the Fed sees all the headwinds to growth here. And remember, rates are high, and they're going to probably hike one more times in our baseline call, perhaps two more times. But I think just looking at inflation, is tough. They've got a dual mandate. They have to look at the employment side, and they have to look at the headwinds that are building. And some Fed officials are highlighting that. This is slightly different from the Fed 6 months ago. That was, I would say, had a one mandate. I think we've moved from single mandate to looking at how do they get full employment and why, and should they not overdo it? You're hearing this "let's not overdo it" phrase come up a lot more. Doesn't mean that they're getting ready to cut rates, but I think the threshold for them to pause at some point and then wait and see the pace of deceleration. And if it is like how Secretary Yellen talked about it, downturn but not recession, they can keep it there. They may have to cut if it looks like a much deeper decline. So I would say, yes, inflation is decelerating, it's high, but there's a lot of other things that the Fed is considering, given that they've tightened very fast. And when you take real rates that high, and 10-year real rates are still well north of what we think is our star, something's breaking. I think we're in the process of something breaking. So I think they have to be concerned. And we're hearing that a little bit from Fed speakers.
Well, a few things broke last month, that's for sure. Priya, Colin, always too short. We're going to have to catch up again soon. Priya Misra, Colin Martin, to the two of you, thank you. The range of views out there at the moment. This from Neil Dutter. That CPI report, fodder for the soft landing bulls. I'll pick up on that in a moment. Coming up, the morning calls and later, why JP Morgan's David Kelly expects multiple rate cuts in 2024.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Equities positive going into the opening bell. Let's get you some morning calls. First up, Baird downgrading Lockheed Martin to neutral, expecting supply chain disruptions to drive mixed quarterly results. Your second call from JMP, upgrading Shopify to outperform, pointing to strengthening traffic data. And your third and final call from UBS, upgrading Goldman to buy, saying the firm looks well positioned for rising levels of volatility. That stock up 1%. Coming up, big bank earnings on deck. That conversation coming up next with JP Morgan's David Kelly. From Washington, this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Three seconds away from the opening bow this morning. Good morning to you all. Equity futures positive by 0.5% on the S&P, a lift on the NASDAQ 100 up 0.6%. CPI, at least for core, basically in line with expectations. For headline, a bit of a downside surprise. A lift in the equity market. There's your opening bow. Switch at the board and get to the bond market. A rally in the bond market. Yields lower off the back of this. The 10-year down 5 basis points. 338, the 2-year down 8 basis points, around about 395, and the dollar a little weaker. Euro stronger, approaching 110, 109.78 on euro dollar, positive 0.6% there. Crude at about 82.20 on WTI, we're positive 0.8%. The broader story for you, 20 seconds into the session, a check of the price action on the S&P 500, positive 0.5% on the NASDAQ, a lift of 6 or 0.7%. One stock to watch at the open, American Airlines, warning that quarterly profits will likely fall short of Q1 estimates amid persistently high cost. Kaylee Lyons has more. Hey, Kaylee.
Yeah, John, the stock down the better part of 5% as trading opens, which at the moment makes it the single worst performer in the S&P 500 this morning on a day when most stocks are higher after inflation. As you said, the issue here is the preliminary forecast, if you will, for earnings does come in a bit light. On average, analysts were expecting earnings of 4.6 cents a share. American says it's only going to be between 1 and 5 cents. So at the midpoint, clearly that falls short of estimates. Now on the top line, revenue was mostly in line, just a touch light. They're guiding for $12.19 billion. But we know what the story has been with these airlines, John. Post-pandemic travel demand has remained incredibly resilient, even in the face of inflation and now concerns about a recession. And that has meant airlines have been able to raise fares to pass on higher costs. And once again, we did see that showing up in CPI with airfares up 4%. Month on month. There are signs starting to emerge, though, that consumers are opting for lower fares. There has been some slowing recently in weekly bookings. So the commentary around demand when we actually do get these earnings calls going to be very interesting, as well as the commentary on cost. Remember, United last month warned about higher labor costs leading to a surprise profit potentially when it reports on April 18th. We get Delta first up tomorrow. American's not going to be reporting until the 27th. But what is it going to mean for a stock that still remains at about half its level it was pre-pandemic?
And had a really good start to the year. Some of these airline names absolutely ripping, hitting some turbulence, so to speak, forgive the pun, in the last couple of weeks. Kelly, thank you. The stock down about 4 or 5% at the moment. Let's stick to pricing pressure in that theme. Rising prices also impacting the US retailers. Argus downgrading shares of Abercrombie to hold, writing, quote, Abercrombie has struggled to expand margins amid inflation and currency headwinds, with cautious consumer spending weighing on sales growth. That's the latest call from Argus on Abercrombie, and I'll try and get the stock up on screen for you. There it is. We're down about 2%. I want to turn to tech. Tesla planning another price cut, this time in Hong Kong. That's the reporting from the Hong Kong Economic Times. This is Elon Musk engages in a fiery conversation with the BBC on Twitter. Ed Ludlow in San Fran with more. Ed, let's start with Tesla pricing, and then we'll get to Elon Musk. What's the latest on that front?
Yeah, so there are a broad range of price cuts coming out of Hong Kong across Tesla models. That, according, as you said, to the Hong Kong Economic Times. Not a surprise, you know, a number of analysts have weighed in this week saying that they expect more price cuts to continue as Tesla pursues volume. But then you also have to make the consideration around the impact to margins. Musk has been pretty clear, right, that Tesla is in a position where it's willing to sacrifice margin and profits over a long term in order to maintain growth as near to 50% annual average growth as possible. So the cuts in the US were broad earlier this week. The timing of them was a little bit of a surprise, but the sell side at least expect that lever to be deployed going forward as we kind of chase that big picture for Tesla, right, which is advance the transition of the Earth to sustainable energy.
Ed, should we talk about unprepared journalists engaging with Elon Musk? What did we learn?
Can you see the bags under my eyes? Because I don't know what you were doing at 11 p.m. Eastern last night, but I sat through the 2-hour spaces. You know, a broad range of questions, many of which Musk dodged. I think the health of the Twitter platform was kind of the biggest takeaway. Musk saying that most advertisers have returned and that the financial health of the company improved. He reiterated a previously stated position that the company could be cash flow positive this quarter. He was pushed on which advertisers had not come back to the platform and didn't answer the question. I would point out, John, because I think it's important for Tesla shares. He said that he kind of reiterated this idea. He can only sell Tesla stock within certain windows, and that he did sell a lot of Tesla stock in order to finance the deal to buy Twitter. He was asked if he had any remorse or regret about how many people were laid off and why he didn't just come in to plug the financial gaps, because he'd said that the severity of the cuts was needed to avoid bankruptcy at Twitter. And he basically made the point, I do not want to sell Tesla stock. That was his base position. That was just some of what was discussed.
Ed, thank you, mate. That stock is up by 1.6%. Tesla, the last week, just hitting a weak patch after a really, really decent year to date. Still pretty decent year to date. I can tell you exactly what I was doing at 11 p.m. Eastern last night. Sleeping a few hours after the football ended. This email came in the last hour, and I promised I'd mention it on air. How are you? Can you say something nice about Man City on the show, please? So this was me saying something nice about Man City on the show. I'm pleased with that. Sticking with tech, Chinese giant Tencent falling by the most in 2 weeks as signs emerge that its biggest shareholder could keep selling. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, Tencent fell more than 5% in Hong Kong trading after news that maybe Prosus is not done selling. They filed to deposit an additional $96 million worth of shares into Hong Kong's stock clearing system. Typically, that precedes a sale, and Tencent shareholders definitely seem to think that's the case, just judging by the price reaction. Now, as of the most recent filings, Prosus is still by far Tencent's biggest holders, as you can see, with a 27% stake. That number had been as high as 29% last year, but the next largest shareholder ranks as at 7.4%, followed by Vanguard's 2.5% stake. Now, Tencent's fall on this Prosus news comes after a huge rally. You can see that shares are still higher by more than 80% from October's low. That's even after Prosus started to pare back its holdings in June of last year. That was to fund its own share buybacks, and the Prosus CEO said that that process is open-ended, John, so we'll see if more sales are truly on the way.
Katie, thank you. That stock is down by 3.8%. Let's turn to the banks. That's where the attention's going to be through the rest of this week, particularly on Friday with JP Morgan on deck. Shares of UBS higher. There is a stalemate in Swiss Parliament over state guarantees for UBS's takeover of Credit Suisse. Shanali Basak has more. Hey, Shanali.
Hey, John, you're looking at a stock, UBS, up about 10% on the year after this Credit Suisse deal really has boosted its prospects across the street to be a global behemoth. But of course, there's this massive dispute within the Swiss parliament about those guarantees given by the government to get the deal done. Now, this vote is largely symbolic. It is largely political, and it regards around the more than 100 billion Swiss franc guarantee the government had given. This is $120 billion we're talking about. So the thing ahead here is the concern that the state guarantees, and I'm using the words of a Swiss People's Party member here, that these guarantees fuel a narcissistic company culture among bankers. Now, this is a lot of anger that remains from 2008. The question here is among future guarantees. Of course, here in the United States, we're talking about guarantees as well when you think about the struggles the banking system has faced and where the government needs to step up. But certainly in Switzerland, there's a lot of pain being felt among Parliament about not only the guarantees that are being offered for this deal alone, but the future strings attached with the banking system as you have lawmakers really discussing here stricter rules and restricted bonuses that would come for the bankers involved in this deal.
This saga, this drama, a never-ending story. Shanali, looking forward to your coverage on the banking sector through the week. That's going to pick up towards the end of the week and then continue through next week as well. About 8 minutes into the session, we're positive 0.6% on the S&P. On the Nasdaq, up 6 or 0.7%. The inflation report, about 68 minutes old now. David Kelly at JP Morgan has this to say: the Fed will cut multiple times in 2024. The prospect of lower rates should help support both bonds and stocks, although it could also allow a continuation of a lower dollar trend benefiting investors in international equities. David, I'm pleased to say, joins us now. David, thank you for your patience. You have the benefit of time on your side. You've had about an hour to look over this inflation report. Let's start there. Are you seeing encouraging signs that disinflationary trend that Chairman Powell hoped had started? Is that process continuing?
Yes, it is, and I'm not sure why anybody doubted it. I mean, if you look at the history of inflation, it follows Newton's law. What goes up must come down. And we were at 8.9% year over year last June. We're down to 5% year over year now in March. As we track the numbers, we think we'll hit 4%, actually below 4% by June of this year. It might be like 3.8. It'll stabilize then for a while, but by the end of next year, it's going to be down to 2% year over year and falling on the CPI inflation rate. So we didn't see core inflation come down, but we did see food and energy come down, and that could feed through to lower core prices down the road. So overall, I think it's a very encouraging report. I don't know why anybody's surprised. I think we've seen this has been in the tea leaves for a long time, but hopefully the Federal Reserve pays some attention to this and realizes that inflation really is coming down.
Do you believe, David, then the Fed might be done, or at least very close to being done?
Well, the futures market is very close to this one. It was betting, about a 65 to 70% probability that they do one more rate hike in May before the report. After the report, those odds have come in a little bit, so I suspect it's close to a 50-50. It depends. I think if anything else goes wrong, if there's any negative sign whatsoever on the economy between now and the May 3rd report, or the May 3rd meeting, I think the Fed's done. They really should be done right now. And I think the committee itself is somewhat split. If you're somewhat split, it would kind of make sense to pause and leave yourself the option of raising rates in June. So if I had to bet today, I think they'll pause, but it's a very close call. I know they should pause, but it's a close call as to whether
David,
they will.
you mentioned your forecast. Let's talk about your calls. You said south of 4 potentially on inflation by year end. I'm looking a little bit further out, and your call suggests maybe 2% by December of next year. And then you say this, the potential for further declines from there. Now, David, I've been told for months by many people there should be a secular component to this higher inflation story, that maybe it's going to be stickier. Do you really believe that maybe that's not the case and that we can get below 2 all over again?
Absolutely, because the number one thing that I'm looking at is the fact that wage growth has been below CPI inflation for 24 straight months. 94% of the private sector workforce in America is not unionized. They ought to be arguing for higher wage increases, but they're not. They're happy to get what they can get. The economy itself is going to be weak. And if you get wage growth to slow down, then all those long-term forces which are pushing inflation down prior to the pandemic, things like information technology and markets, great inequality in income, declining unionizations, all those things will still be in play. And I think this is fundamentally a disinflationary economy. I think that was interrupted by extraordinary fiscal stimulus in the midst of the pandemic, but I think it'll reassert itself. So, I think it's back to the future. I think by the middle of this decade, the inflation story is going to be exactly what it was in the middle of the last decade.
So are we saying that we're back to the 2s, inflation at 2, GDP at 2, and maybe even rates at 2? Are we going back to that?
I think I'll take the under on the first two numbers. I think we're going to go below 2% on trend GDP growth. I think trend GDP growth is only 1.6, 1.7% in this country. I think inflation will come down below 2 also. I think on rates, though, the Federal Reserve hopefully will stop in the middle. I mean, there's nothing has really helped by pushing rates down to a zero lower bound. All that does is it creates asset bubbles and distortions. It doesn't really stimulate the economy. So I think the Federal Reserve will cut rates throughout 2024, but I think they'll probably stop off at somewhere like 2.5% of the federal funds rate on the way down. I don't think they're going down to zero. But slow growth, low inflation, that's I think where we're headed.
Can I just jump in on the market call then and try and reconcile this with your view on international equities? David, why wouldn't this just lead to the return of US outperformance and US equity market dominance led by tech?
Well, first of all, very slow growth, I think, is going to hurt US performance because I think you're going to see faster economic growth overseas. I also think that the inflation problem could be stickier overseas. I mean, as we talk to our European economists, they're not nearly as optimistic as I am on inflation, and probably for good reason. I think wage growth will be stronger in Europe. And if that's the case, then, I think the European Central Bank will probably stay tighter for longer. I think that's probably also the case for the Bank of England. So you'll have a situation where the Federal Reserve, having overshot its cutting rates, the ECB and the Bank of England are keeping rates high. That should push the dollar down. And if it pushes the dollar down, it should lead to international stocks beating US stocks. It is true that lower rates could help tech stocks in general, but I think that bigger trend of a lower dollar will probably dominate here.
Dollar's weaker this morning, that's for sure. Dollar index back to about 101. David, enjoyed this as always. David Kelly there of JP Morgan on the latest inflation data, where he thinks this is all heading, which is kind of back to where we were pre-pandemic, which is also the view of some people at the IMF. I know a lot of people watching this program take the other side of it, but that's just a range of views right now. Big range of views on the big arguments at the moment. On the S&P 500, 14 minutes into the session, we are positive 1/3 of 1%. This move fades just a little bit on the NASDAQ. We're up by about 1/3 of 1%. Coming up next, inflation in America showing signs of cooling.
Lowering cost for the American people is a priority for him, and he'll continue to certainly do that.
What the CPI print means for the Biden administration, that conversation up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, they're half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
When it comes to lowering cost for the American people, this is, as you know, something that the president, when you look at his economic agenda, when you look at his economic policy, lowering costs for the American people is something that is at the center of that, is a priority for him, and he'll continue to certainly do that.
A key inflation print keeping a May rate hike from the Federal Reserve well in play as the White House continues to grapple with rising prices. AMH back with us here in D.C. with more. Hey, Anne-Marie.
Hey, John, we're still waiting for the White House response on this, but you can imagine what they're going to do is just cherry pick the data that makes sense for them and their agenda. So they're going to look at the headline, the inflation at 5%, a tick under forecast, and they're really going to want to lean to the two things that affect Americans. Many Americans drive, energy prices are down, and also grocery stores. Everyone goes to the grocery stores, and food prices are down. So this is kind of the data I can imagine the White House is going to want to tout today. The issue obviously have is the core that remains elevated, and also, as Mike McKee and I were talking about earlier, gas prices are actually on the rise, and this is happening ahead of peak driving season in the summer, and many are pointing to what OPEC Plus just did, which is taking some supply off the market. So gas prices potentially in the next few months could become another headache for the administration.
I have no doubt we'll get a White House response at some point in the next couple of hours. Anne-Marie's going to bring that to you. Allow me to bring you to the price action just briefly. This market not as enthusiastic about what we saw an hour and 20 minutes ago. The initial reaction, equity futures were higher by about 1%. Yields were lower by more than 10 basis points. On my screen right now, the S&P 500, just about positive still by 0.2%. 20 minutes into the session on the NASDAQ, we are just about positive, and at one point turning negative. In the bond market, that move fades as well. Yields are still lower by 6 basis points, sub 4% just. The 2-year, 396. The 10-year down about 3 or 4 basis points, just sub 340. More economic data and Fed speak still on tap this week. You'll hear from Mary Daly of the San Francisco Fed. She'll speak at noon Eastern, followed by the Fed minutes a little bit later on this afternoon at 2 p.m. Eastern time. Mike McKee, those Fed minutes, how important are they going to be a little bit later this afternoon?
Well, the problem with the Fed minutes is that they are always 3 weeks old, and so a lot happens between now and then. We're going to be looking primarily at what they were thinking of the banking situation at the time, because you remember we went into that meeting with SVB and Signature Bank closed, and a lot of concerns about whether this would be a broader banking crisis. So we'll get their views on that and get their views on where inflation was going. But we've heard from Fed officials over the last 2 days about how they think the banking crisis has settled down. Now, they can't cherry pick numbers, as the White House may, as Anne-Marie was saying, but you look at the chart here with the red line, that's when the Fed started raising interest rates, and yeah, inflation has come down, but unemployment has also come down. And that wasn't supposed to happen. It's not matching their forecast. So one of the questions for them is, why is unemployment staying so low? And is there a danger it's going to suddenly shoot up given all the layoff notices and given the tightness of the Fed's policy at this point? As John mentioned, we got Fed minutes today, but then we still have some other important numbers this week. We have jobless claims and PPI tomorrow. Jobless claims in part or in large part because of seasonal adjustment jumped last week. So is it technical, or are we seeing a sustained rise in claims? Be a lot of interest in that. Retail sales on Friday, and I heard, John, you talking about it earlier, there's definitely some negative outlooks from some of the banks about consumer spending during the month. And then we go to the end of the month, we get income spending and the PCE index ahead of the Fed meeting. And that isn't as much data as we had before the last one. So we're going to have to make a lot out of what we get.
That gloomier view on consumer spending echoed by Bank of America and Mike Gapin a little bit earlier this morning. Mike, thanks for that. I'll try and bring you as much research as I can from the South side. This from Ellen Zettner and Morgan Stanley, who say this morning: a slight slowdown in core inflation with significant deceleration on core services should be a positive signal for the Fed. They go on to say that shelter inflation still has to show more signs of turning decisively. The ultimate conclusion, though, for Morgan Stanley, and many of you I know, we see the data firmly supporting another 25 basis point rate increase in May. That's the view from Morgan Stanley this morning. Let's get you some sector price action. This equity market pop fades just a little bit more. Here's Katie.
Hey, John. Well, the S&P 500, it's only up about 0.2%, but you're looking at a pretty broad rally underneath the surface. 10 of 11 sectors in the green right now. Financials leading the way up 0.5% or so. And then you look to the downside and you have big tech. And big tech has been interesting over the past 4 days or so. It's had a habit of climbing throughout the day. You add that all together, though, it's still lower.
Katie, thanks for that. Your equity market more broadly, as I say, around the CPI report, a decent pop. That phased just a little bit more. This week, still a lot more still to come. Mike went through the data. Bank earnings coming up just around the corner as well. Your trading diary up next.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody is talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
To office push continues. The latest from JP Morgan calling managing directors into the office 5 days a week. MDs back to the office 5 days a week. That headline crossing just moments ago. Allow me to bring you the trading diary just briefly. What you need to be watching this week. The Fed's Barkin and Daly speaking later this morning, followed by the Fed minutes at 2 p.m. Eastern time. US PPI and another round of jobless claims coming on Thursday. Plus, President Biden meeting with his Irish counterpart later that afternoon. US retail sales out on Friday, and the big banks kick off earnings with results from JP Morgan, Wells Fargo, and Citigroup, all on deck. From Washington, D.C. this morning, good morning. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website PepsiCo